So good morning, everyone. I'm Eileen DeGringy. I'm Community Development Research Manager here at the Federal Reserve Bank of Philadelphia. I want to take a minute to welcome you to the bank and to thank you for being here with us this morning. I would also like to welcome our virtual audience. Thanks for tuning in. We're hosting today's event in partnership with the Pew Charitable Trusts Housing Policy Initiative. And I'm really excited for the program that we've put together for you today. Manufactured housing is a timely and important topic. We've assembled experts from a wide range of perspectives, including state and national policymakers, researchers, lenders, people with lived experience in manufactured housing communities, to help further our understanding of opportunities to expand and preserve affordable manufactured homes. So a couple of logistical notes up top. So for the question and answer today, both virtually and in person, we will be using Slido. It's easy to use. You just go to slido.com and enter in the MHO opportunity keyword, and you can submit questions. You can vote on other people's questions and the kind of questions that the most people are seeking to answer. It will hopefully be able to. So please use that throughout the day to participate in the Q&A sessions. If you are for whatever reason, asking a question from your table, please make sure for the benefit of our virtual audience that you use the microphones at your tables. For our in-person audience, we have some event photography waivers on the table. Please sign those. If you have any questions about those, please reach out to Grace Henry from our team during the break. And then after the event, we're going to ask you to take a feedback survey. Please, I encourage you to complete that survey. We always are eager to hear from you to learn about what worked about our events and how we can improve future events. Before I hand things off, I want to acknowledge some of my colleagues here at the bank who were working behind the scenes to make today's event possible. So starting with my colleague, Patricia Bell, who's on our community engagement team, our content coordinator, Grace Henry, leadership fellow, Nikki Hazlitt, our Nadej Toth and Josh Rivera from our meeting services team, and Jeremy Overwood from IT. Thank you all very much. And with that, I'd like to welcome Travis Plunkett from Pew Charitable Trusts to introduce our opening speaker.
Morning, everyone. I'm really glad you're all here. Thank you, Ellen. Thank you to everybody who's organized this important event. I'd like to thank Rachel Siegel and Tara Roche with Pew, and we are so excited to be with our partners and colleagues at the Philadelphia Federal Reserve on this very important topic. I'd like to introduce our Executive Vice President and Chief Policy Officer, Michael Caudell-Feagan, who directs programmatic work for Pew around the world, which includes policy work, technical assistance to governments, and research on a diverse array of issues, including environmental protection, hometown issues here in Philadelphia, biomedical research, healthcare, and of course, housing. So we're really glad that Michael could kick us off and looking forward to hearing what he has to say. Michael.
Thanks, Travis. It's my great pleasure to join Eileen in welcoming you all to, I think, a very timely discussion. We're particularly pleased to host this with the Federal Reserve Bank of Philadelphia to really look about how to improve the financing, community infrastructure, and wealth building potential of manufactured housing. The Federal Reserve is known for its reputation for promoting high-quality research on important issues, including inclusive economic growth and fair and impartial access to credit. Pew itself is an organization with over 75 years of rigorous, nonpartisan research and a strong commitment to public service. Our program touches on many facets of American life that are experiencing profound change. High among these is housing. Our nation is feeling the effects of some of the greatest housing challenges in our lifetime. It is harder than ever for families to achieve their homeownership goals. At a time when housing supply is extremely limited, levels of homelessness are at their highest in a century, and first-time home buyers face a difficult uphill battle, we are reminded that no community is immune to the effects of a tight housing market and its costly impacts. Pew is committed to advancing federal and state policies to assess, plan for, and improve access to manufactured housing. This type of housing can help solve many of the challenges with high home prices and low supply. Manufactured homes are cheaper to construct than site-built homes. They're made to high-quality standards, and they are a great option as infill in urban and suburban areas and as accessory dwelling units. The technical assistance and targeted advocacy that Pew provides are designed to help federal agencies and states deliver better results by modernizing the policies that undermine the potential of this market. For example, restrictive land use regulations that disallow manufactured homes in neighborhoods, which limits home availability and drives up home prices. And policies that have simply not kept pace with the financing that manufactured home buyers need. To that end, Pew's DC and Philadelphia based teams are leading important, inclusive economic development work alongside many partners to tackle these and other housing challenges, such as rental housing regulations, tangled titles that reduce housing habitability and ownership opportunities, retirement savings, and educational debt. And of course, on today's topic, to ensure that Americans have access to safe, affordable, low-income homes. It's clear that the US has been underbuilding housing for years, not just in cities, but suburbs, rural areas, and manufactured home communities. But Pew's research shows that we also have an opportunity to fix that. This convening is a sweet spot for Pew. It shows one of our greatest strengths, which is to bring the stakeholders together that have the ability to contribute to the solutions. We know that modernizing policies will help federal and state policymakers to better meet the housing needs of the US, reduce homelessness, and increase access to safe, affordable financing. But there are questions about how to achieve these goals effectively. It's your experience and know-how that are critical to answering these questions. Together, we have the opportunity to improve policies to deliver better access to affordable, low-cost manufactured housing for people and communities across the US. I'm therefore exceptionally grateful to each one of you for your partnership with us in this effort. Looking forward to the conversations today. And in order to get to the substance, I appreciate the opportunity to turn it over to Rachel.
Good morning. Thank you all for joining us today. My name is Rachel Siegel. I'm a senior officer on the Housing Policy Initiative at the Pew Charitable Trusts. And today this panel is going to talk about how to address financial barriers to accessing manufactured home ownership. So before we get into the weeds today, I want to set the stage and talk about what manufactured housing is, as well as why it plays an important role in our housing market. So first of all, manufactured homes are honestly the modern mobile home, constructed mostly in the factory and then driven nearly whole to the site where it's going to be installed. And these homes really fill an important housing supply shortage. There's a drastic shortage overall in housing supply in this country right now, but there's especially lack of new, smaller, more affordable homes. These can be starter homes, homes people downsize to, or honestly just homes people can afford to be in. But there's a real big lack of access to safe and affordable financing. And this component is crucial in order for people to be able to purchase these homes, as well as for them to remain affordable and for them to be stably housed in these homes. So I wanted to give you a little bit of a roadmap of what we're going to talk about today. It's quite a bit. I'm going to talk through some of the land tenure components of manufactured housing, how these homes tend to be titled, access to credit, mortgages, which we mostly know about, and personal property loans, which are pretty unique to manufactured homes. And then some of the challenges that come up for both lenders and borrowers in access to credit, and ways to improve this access to credit, which we'll talk about a lot more on the panel. So land ownership and titling both really dictate a person's ability to get a mortgage. So real estate on the far left here is something that you're probably all familiar with. Most single-family homes are titled as real estate. Home and land are titled together. And for manufactured homes, this is absolutely possible in the vast majority of states, but most places require that there's direct land ownership and that land ownership is the same as who owns the home. Now, what's unique about manufactured housing is that it's sometimes titled as personal property. This is really more like how you title a car. This is when the home and land are titled separately. Now, most people think of this as in land lease communities where you pay to rent your land. But there's really a wider array of how people own their land or rent their land. So for example, unpaid lease land, so folks living on family land, folks in tribal land, indirectly owned land like resident-owned communities, co-ops, and directly owned land where folks actually own the home, own the land, but the titling is separate. And so they own it as personal property. Now, how does this play into financing? If you have a home that's owned as real estate, then you can get a mortgage loan. This is very much the same as it would be for any single family home, usually 30-year terms, lower interest rates, and really robust consumer protections. This is the gold standard of how we finance homes in this country. But this is often not an option for folks who own their home as personal property. In fact, folks who own it as personal property can never do it as a mortgage. So in these cases, it's a personal property loan. Sometimes these are called home-only loans or chattel loans. And just the home is serving as collateral. Now, personal property loans tend to have shorter terms, 20 to 25 years, higher interest rates than mortgages, and fewer consumer protections, especially in default. But I want to just take a second here to say, while a mortgage loan is preferable, and when it's possible, that's fantastic, a personal property loan is really the next best thing. When neither of these options are available, we see folks turn to much riskier scenarios like rent-to-own, contract for deed, installment sales contracts, which have virtually no protections. So I wanted to just note here that mortgage use also varies widely by state. Zoning restrictions really limit the ability to put a home on owned land and then be able to title as real estate and get a mortgage. So this is one area where there's a lot of variability, especially in metropolitan areas, less so in rural spaces. And then state titling laws also have an impact here. And I wanted to make a mention that New Hampshire is really distinctive. 32% of all of their loans are mortgages, but are on home and land. But in fact, all of their loans are actually mortgages because the state automatically titles as real estate. But that's the only state in the country that does so. Every other state automatically titles as personal property, and most of them you can change it to real estate, but the process varies. I'm gonna skip that slide and come back to it. Because I wanted to talk a little bit about the challenges in the market for personal property loans. So this is some of Pew's research. When you look at the right-hand side, it shows the mortgage market compared with personal property loan market. So from 2018 to 2022, each loan type, depending on whether the loan has some kind of federal backing. So federal backing meaning FHA, VA, USDA, or purchased by a GSE, Fannie Mae or Freddie Mac. Now, if you look at the middle column here, this is showing us manufactured home mortgages, and the right column is site-built mortgages. The teal color shows that more than 2/3 of all mortgages, both for manufactured homes and site-built homes, have some kind of federal program backing it. And this really makes it easier for lenders and borrowers to access financing. Now, in stark contrast, if you look at the left, this is personal property loans for manufactured homes. Virtually no federal programs have any kind of backing, insurance guarantees, purchasing of these loans, which makes it really hard for most home lenders to participate in this space. And as a result, barriers to entry for home lenders are really high. And just 5 lenders make about 78% of all personal property loans in the country. And most of the lenders that do make these loans are keeping them on portfolio, although we'll talk about a different model today as well on the panel. But I also want to mention, this is not to villainize the lenders that are prominent in this space, but rather to point out that it's very difficult for most home lenders to participate. It creates an uncompetitive market, and uncompetitive markets just tend not to be ideal for consumers, leading to higher costs usually and lower access to financing. So now to go back to this one, I wanted to show you some of the research that we've done looking at denial rates. So specifically, these are denial rates by housing type on whether the home had any kind of federal backing. So the conventional loans on the left are loans that don't have any kind of federal backing. And then you have the Federal Housing Administration, FHA, and Veterans Affairs, VA loans. Denial rates for mortgages for site-built are in blue, manufactured home mortgages are in teal, and personal property loans are in orange. On the far left are conventional loans, mortgages and personal property loans. And this graph shows completed loan applications. So when an applicant is trying to get a loan to purchase a home for their primary residence. And to clarify, this doesn't include any applications that were withdrawn or incomplete. Now, nearly 2/3 of conventional personal property loan applications were denied, and over half of conventional manufactured home mortgages were denied. And research from the Consumer Financial Protection Bureau really echo this, showing that even when they controlled for credit score, these stark differences still exist. But what was really striking here and easy to overlook is how much easier it was for folks to get FHA loans and VA loans. But what's distinctive is FHA, anybody can get. You don't have to be a veteran. With denial rates for manufactured home mortgages at about 13 to 14%. So I'm happy to say David from FHA is here on the panel. And we're talking more about this, but these data analysis really opened our eyes to the idea that FHA is already playing a really prominent role in the mortgage space, providing about 1/3 of all manufactured home mortgages. And they have a program that needed updating. It had become obsolete for personal property loans. And so they've been in the process of making those updates. So thinking about how the federal programs could start to fill some of the gaps in access to financing is key. So I wanted to give a couple of things to just keep in our mind as we turn to the panel. Mortgage financing is out of reach for a lot of folks buying manufactured home. It's the gold standard with the strongest consumer protections and lowest interest rates, but they're just not possible for many home buyers and owners who own their home as personal property. Personal property loan borrowers have very few options. There are no federal programs currently working in this space, few lenders, and really high denial rates. And again, the alternatives to these are far riskier. Access to safe and affordable financing is a really crucial component of whether a person can buy a home, whether they can afford the home, and if they'll be able to stay in that home. So with that, we're going to turn to this fantastic panel. I'm going to ask each of them to introduce themselves and give a high-level overview of their business, what they're working on in manufactured housing. So thank you all so much, and I'm going to turn it over to Dina.
Thank you. Hi, I am Dina Levy. I'm the Senior Vice President for Homeownership and Community Development at the State Affordable Housing Agency called HCR in New York. And I'll just quickly touch on the work we've been doing around manufactured homes sort of broadly, and then get specifically quickly into what we're doing on the liquidity side. The first thing I'll say is it was a little bit surprising to me when I first came into this work about how much manufactured home and how many communities, manufactured home park communities we have in New York State. So we have about 2,000 parks, which is about 80,000 pads of housing in varying conditions. Some are excellent, some less so, but it's a lot of housing, and it has been largely sort of underserved, I think, by collectively all of us, the state, but also the Affordable Housing Network. And so I think our first goal was to sort of figure out how to bring this housing stock into the conversation and into sort of the minds of all of our partners in affordable housing. So the first thing we did was we sought and got funding from our legislature, which is now annual, to enable us to do sort of traditional financing at the park level for both infrastructure improvements, but also for acquisition. Sometimes we refer to that as preservation sales. So whether the tenants want to own the park or whether there's a not-for-profit, we've had to do a little cajoling to get our non-for-profits to think about this, but we've been able to now successfully finance both acquisition and then with existing owners, renovations that would make significant investment into the quality of the infrastructure of the parks. The second thing, and this really comes more to the liquidity, is we wanted to create a mechanism to do real property mortgages in parks. We thought we could do this because we also do lending through our state of New York mortgage agency, so the liquidity agency for New York State. We do lending in like land trusts all the time, right? So we thought, well, we already have a model. We know how to make a loan for the improvement, but not on the land. We should be able to replicate this in parks. And so we launched a real property mortgage program for manufactured homeowners in parks on leased land. It's tough. It was tough, right? So we spent a year trying to work through the kinks, onboarding a bunch of park owners, working with a lot of individuals who wanted to get the financing, structured as a leasehold mortgage. The issue really was the number of parties that had to consent to just do a single loan, right? So first we needed the homeowner to agree, the park owner to agree. Then we realized if the park owner has debt on the property, the lender has to agree. Often that was Fannie and Freddie. It took us a year negotiating with it. It was, a drag. So we did it and we closed about, 36 loans over the pilot. But ultimately we realized this was not something that we could scale easily. And so last year we went to our legislature and asked for permission and was granted that permission to allow the Sunny May, the state of New York mortgage agencies, to start doing personal property loans in parks. So what is typically referred to as chattel, we're not going to use that term, but we are now authorized to use our bond financing, both tax exempt and taxable, to create a new personal property loan for homeowners who want to site their homes in parks. We are super excited to launch this. It will include some things that I think will be very meaningful, including down payment assistance, which we think will go up to about $30,000 per home as a grant that is non-repayable as long as the homeowner stays in the home for 10 years. We are going to voluntarily layer into the program a loss mitigation option, which is not very common in the chattel space. So if a homeowner gets into trouble, either on their land lease or on their mortgage or personal property loan with us, we will have a mechanism to do mortgage modifications, term extensions, all the things you would normally see in traditional lending. Those are sort of the keys, but we will also be, keeping interest rates as low as possible, which, will model fairly closely to our normal mortgage business. Today, those rates are a little higher than we'd like, but still hovering around 6%. So this will be much, much, much more affordable than what we have traditionally seen in the chattel space. And so that's it. That's what we're working on. There's one thing I'd also like to just mention that has been critically, I think, helpful to moving this along. In 2019, we also went to the legislature and pushed for regulation that now restricts how much lot rents can go up in a given year. So that is generally now capped at a 3% increase annually. There is a little bit of a loophole that will allow for up to 6% increases if there's an investment or a reassessment on taxes. There's some abuse in that space, but generally it has largely been very successful at keeping some of the predatory investments of purchasing parks out of New York. It also makes us much more comfortable in terms of being able to lend, knowing that there can't be wild, crazy rent increases. So that's what we're doing.
Thanks, Dina. Steve.
Thanks for having me here, and I think I've really got to figure out how we get Dina to New Hampshire. I think that's going to be really important for our sector. Yeah, exactly. I work for the New Hampshire Community Loan Fund. It's a 41-year-old community development financial institution. We do a couple things. We do a lot of community solar lending for low wealth communities. We serve Black, Brown, Indigenous entrepreneurs, helping them start business, and on our best days, helping them buy buildings so they can't be displaced from their neighborhoods. We have a long-standing sustainable food program that also has a climate bent. But our bread and butter is manufactured housing. And that's sort of where we start and where we go to bed at night thinking about. 41 years ago in Meredith, New Hampshire, a park owner was going to sell to a hotel developer, essentially displacing the 19 families who lived there. So we raised hell, hired a mean civil rights lawyer, and organized those 19 homeowners into a cooperative and helped them buy the park. And in that time, in the last 41 years, we've organized 149. The 150th will be closed any day now into what are resident-owned communities. We also helped spin off a national nonprofit called Rock USA. Well, you'll hear from Jeannie Wright later today. And everybody should stay till 1:15 because I think the stuff Jeannie's going to do with her panel is really interesting. But we learned 20 years ago, organizing residents to buy the parks wasn't sufficient. So we started doing fixed rate 30-year mortgages. I think the first one in the country to be a 30-year fixed rate mortgage. In that time, we've done about 94 million of them. Average size is about 68,000. And because we're all here to learn, I'm just going to let everybody look under the hood and all the good stuff and all the bad stuff. In that time, we've had 21 charge-offs, 20 deeds in lieu, and 42 foreclosures. So about 2.5%, of all the loans we've made have been charged off, just to give you a sense of where it is. I think about a third of our loans are to people with a 620 credit score or lower. And we do some of the stuff that Dina is doing, but I think we're going to plagiarize more of what she's doing. I think the most exciting part of this panel is going to be when we get into the how. But I'll throw out a couple teasers early. We manually underwrite every single loan. And out of every 6 inquiries, probably 1 gets through to a finished mortgage. And the manual underwriting is both what's great about us, and it's also the problem for many of the researchers in the room about how we get scale and velocity. And Jeannie this morning, she and I were talking, and one of the biggest investments we're making now is in policy. And when we get to some of the problems that Rachel's going to tee up later, and I'm glad David's here, that's really where I think a lot of the change needs to occur. But really appreciate Pew and Philly, FRB, caring about this space. When you're a houser, manufactured housing, you can sometimes feel like you're in the wilderness. So it's a real thrill to be here.
Hey everyone, good morning. I'm David Sanchez. I am a senior policy advisor in HUD's Office of Housing, which contains both the Federal Housing Administration as well as HUD's Office of Manufactured Housing Programs. And it's such a pleasure to be here with some familiar faces and some new faces. So in my job, I get to serve as a policy analyst and advisor, focusing a lot on FHA's single-family programs. These are the 30-year fixed rate, relatively low interest rate mortgages that FHA backs across the country to first-time homebuyers. We are famous for having only a 3.5% down payment requirement, and for having more liberal credit standards than a lot of other lenders or backers of lenders. That's a great thing to work on. In many ways, I think, what Rachel is saying is that is kind of the gold standard, like 2008 and the foreclosure crisis aside, we have built in this country a really, really efficient and scalable and impactful system to fund mortgages. And we simply, I guess part of the message of this panel and part of what I'm here to say is we're not doing that right now on the home-only lending side. Fortunately, I think FHA, has some tools that it's going to be able to offer, but it's going to take all of us in this room and many more of us to figure out, if we ultimately do want home-only buyers to have access to the same quality financing, I think there's a lot of things that need to be fixed. So within my office, I'm grateful to have a view on a couple of different things. So there's FHA Title II, where we do manufactured housing titled as real estate. We have what is called the Title I program at FHA, which historically, it started in the 60s, has been a primary way that borrowers are able to get home-only lending because it can back chattel or personal property loans. That program was pretty well used through the 90s, but ultimately has fallen into disuse. And in recent years, we haven't seen any originations. and in fact, since 2008, we've only seen about 6 or 7 lenders use the program. That's not, that's not what it was designed for. It's not designed to be a niche program that really only used every now and then. What we would really like to do is, we'd like to provide the liquidity and the confidence to the market so that lenders can go out there broadly and offer these loans. So I spent a lot of time, cranking through the gears of the federal government, trying to get reforms made to the Title I program so that ultimately it can attract lenders again and consumers can begin to benefit. So that's probably the main thing that I'm here to talk about today. I'm also grateful that FHA's multifamily insurance division is exploring the role that HUD could play in backing loans on manufactured housing communities. We announced, I think it'll come up on a later panel, but we announced a small program through our 223F, for those of you who know the multifamily lingo, where manufactured housing communities are going to be eligible for financing through those programs. We also, in our office, we get to administer the installation and dispute resolution programs that Congress has authorized, and we are the body that updates the HUD code itself. So, we spend a lot of time thinking about what are the safety and construction standards that we need to hold everyone to, and how can we modify the HUD code in order to promote greater innovation, greater affordability, more flexible, more types of housing that people want to buy. And then, just as a final thing, there's lots of different parts of HUD. And there's a lot of enthusiasm within HUD and in the Biden-Harris administration about the promise of manufactured housing. We are also, we're modifying our grant programs so that CDBG and home funds can be used more easily on manufactured housing. We are rolling out, and I don't know if applications are open or closed, although I should have known this. I think maybe they just closed for price. The first of its kind grant program that Congress authorized, giving grants directly to manufactured housing communities to improve their infrastructure and other purposes. So it's great to be here, and I'm excited to talk about HUD's role in all of this.
Thank you, Rachel, and thank you, Pew, for having me here today. My name is Todd Kopstein. I'm the Chief Executive Officer of Cascade Financial. We are one of the few lenders that are making chattel loans today, so thank you for not villainizing us. Appreciate that comment. We make all different products of loans. So we have FHA insured loans, we make VA insured loans, we make portfolio loans, chattel, in community, on private property, and we also do portfolio land home. I believe we're the only national lender to do all those products. We're agnostic to what the borrower wants to take. Ultimately, we're trying to provide capital, provide a solution for the borrower so that they can buy a home, and whatever works best for them works for us. We've been making loans since 1999, although we started making chattel loans in 2017. So we've been around for a long time, seen up and down cycles. And we've been doing this with these borrowers for quite a while time. And we know that the borrowers perform. We can get into that in a little bit, but as was mentioned earlier, properly underwritten, properly serviced loans perform. We are the first lender to bring a securitization of newly originated manufactured housing loans to the market. We did that in 2019. Most people said it couldn't be done. We're able to do it. Unfortunately, that securitization market is still very inefficient. And our goal is to try to bring down the cost of funds for lenders like ourselves so that others can participate and provide credit to people and help solve the affordability crisis out there.
Great, thank you all so much. And it's very clear as I knew this going in, but as I listened to everybody, this is like a very busy panel up to a lot. So I guess my question to you all is, do folks feel like they've already talked about why they're in the space and why they're passionate about it? I heard a lot of reasons, but if you have additional things you wanted to talk about on your passion and motivation, I would love to hear about that. But if not, we can skip it.
Happy to.
Todd, yeah, please.
Sure. So I should have mentioned also that I believe we dominated the FHA Title I market last year. I think there were 3 loans done, and we had a dominant position there. So we've tried all the different products, but I am passionate about helping to solve the affordability crisis. I do believe, as everybody I'm sure in this room does, manufactured housing should play a larger role and is part of the solution. I also believe that the government has a place to play, whether it's FHA Title I or Fannie or Freddie. If you think about the people who need help in the country to buy a home, there's no better set of people than the people who are buying manufactured housing. We're talking about people who are lower income, people who have less formal education, people oftentimes live in rural neighborhoods, and people who are trying to buy a lower price point home. So they're trying to buy a smaller footprint home at a lower price per square foot. Low balance loans are really tough. The mortgage market knows this. Low balance loans are really tough to underwrite and originate. If there's anybody who needs the help of Fannie, Freddie, the FHA, or VA, if they were to get involved, it would be these borrowers. And to the extent that any of those institutions have a mission to help affordable housing, they're not doing it. This is where they should target. All the other things that they do, I'm not here to talk about whether they're great or not, but clearly they provide liquidity to the mortgage market, and there's a real need for that. But this should be priority one, in my view. So I am passionate that there should be a solution. If there's not a solution from the government, in the meantime, capital markets can play a role as well, the private capital markets. And there's a very meaningful role to be played there. And in order to help bring down the cost of funds, the rating agencies have to play a very large role. The SEC obviously regulates the rating agencies, and to date, they haven't played that role. So they haven't thought of it as a commercial opportunity, and that's unfortunate. But there should be, amidst all that universe, the proper impetus to help solve the problem that we have in this country. So I believe that those are part of the answers. I'm passionate at trying to get any or all of those institutions involved to help the borrowers get into a home they can afford.
Todd, the work Todd's doing is really exciting, and it reminds me of a conversation that we had with one of the GSEs. Their policy was made on a data set of 4,000 homes from 2009. You know, that before we get into the policy solution, we have a data problem, and that's why it's really exciting that both Pew and Philly, FRB, are taking this on.
If we want to jump into the data, I'm happy to go straight there. So I will say that HUD, having the advantage of having the Title I program operate for decades, does have a sample of 3,000, 4,000 loans that can be used to judge the performance of these chattel loans, and you can look at HUD's losses. And the story that you see from that data, it's been published. There's a Cityscape article out there by Kevin Park that I encourage all of you to go read. It doesn't necessarily look like the success stories that we hear so often from like what Cascade is originating or what we hear from the New Hampshire Community Loan Fund. So I do think that really highlights there is the opportunity to, as a lender, lose a lot of money in this space. These are lower income consumers. That they face greater volatility, and that really bears out in the HUD data. That being said, I think we know we can do better. HUD doesn't have automated underwriting or a scorecard for these loans right now. These are all the loans that are in the sample data set were manually underwritten, which is sometimes great and works really well for some lenders, but doesn't work as well for other lenders. It's our hope that as we are entering into this space, we are we want to expand the credit box from where it is today, because I would say that the 6 or so really active lenders in this space, they all have their own business models, and they're really impressive business models, and they're really awesome. But I don't think we see the market serving people with lower credit scores or people who are putting very small down payments down in a way that we might like. But at the same time, as we seek to serve those borrowers, there is a reason why a lot of people at HUD were not enthusiastic about the Title I program. Get a loan at Ginnie Mae, where they've had tremendous problems administering the securities that these loans go into. I think it's just really important that as we're coming back and getting back into this industry, hopefully we are originating the kind of quality loans, the kinds of performance rates that you hear about on the New Hampshire Community Loan Fund portfolio are incredible. And we would love to figure out how to bring that special sauce to everyone.
Yeah, so this isn't one of my official questions, but is there a way, maybe Steve or Todd have some ideas on like, how do we scale this secret sauce on how to originate loans in a way and service loans in a way where, FHA can bring good quality loans that perform well, where folks can stay in their homes and aren't set up for a bad situation?
I'm happy to take that. So we obviously try to scale, and so we have very strict guidelines on underwriting, for that matter, servicing. But in terms of underwriting, we don't make any exceptions. So while we have people going through and ensuring that borrowers have the ability to pay, and we talk about that in a little bit as well, there's no exceptions to make sure it's statistically significant when people look at data and say, here's a propensity to default, given these characteristics or these set of characteristics, risk overlays that we put on them, and so that they're statistically correct over a law of large numbers will show propensity to default for various cohorts. So we have that data, we're building that data. That data it's not in the public domain, but the government has that data. And so theoretically, the government can get it through some combination of the credit repositories and HMDA data or otherwise. The data exists. It's just a matter of getting it to the right people and showing them that these set of characteristics, us and the other lenders that you talked about all work in a similar fashion, right? We're all trying to scale. So the data set that we have in the public domain, or not the public, the data that is out there for the last 10 years of origination would be highly indicative of how the collateral can perform if you have strict underwriting. We're all keeping credit risk in some way, not all of us, but we are. And so we're lending with the idea that they should perform. We want to own the credit risk. So I think that data would be informative to the FHA or to Fannie and Freddie as to how borrowers would likely perform if you were underwriting them to today's standards. Right? If you're looking at Title I program from pre-crisis, pre-Dodd-Frank, when there wasn't ability to pay and there wasn't as many guidelines around how borrowers would perform, it's a different animal. It's sort of like comparing the subprime lending of 2005 and 6 to today and saying, all right, they're the same, but they're not the same. We all know that. So I think you need to look at the data set that's really relevant in looking at how borrowers are likely to perform.
Yeah, Steve.
I think that there's not a one solution to this. I could see, Todd being Amazon and maybe on Dollar Store or Walmart in terms of who we serve. Like we really want to serve people at 30% of AMI or lower. And there are some situations that we want to deal with. Like if you want to get into manufacturing, you start as a temp and you probably move from manufacturing place to manufacturing place, trying to get a better job and more income. Well, that doesn't work for Todd, who's trying to underwrite a lot of mortgages. If you're a homeless veteran, well, we may work with an organization to say, well, we've got some infill spots at some of the rocks in our communities, and we're just going to go ahead and build 20 homes, and we're going to put people there and work with the VA. That, again, doesn't lend itself. It needs to be manual. Well, what I think you can do is that two things. You can make community development financial institutions, CDFIs, certified Fannie Mae lenders, which none of them are right now. Mm-hmm. And then the second thing is, instead of backing my individual mortgage, my organization has a 20-year history. You can look at us. Why don't you sort of underwrite our portfolio or make a credit enhancement grant that we offer to leverage in a certain way? And that'll give us the ability to sort of look at incidents, and severity, and then look at that impairment number over what is the standard terms of our loans. And, in truth, even though we're making 30-year fixed rate mortgages, the average term tends to be about 7. So we can actually analyze that. So you'll get a lot more if you say that you want homeless veterans housed, you want people that are working in manufacturing, moving from place to place, a school teacher may not have a great credit history. If you want those people to be able to buy a home, a credit enhancement grant to an institution like us, and we'll back it with our balance sheet, that would allow us to do more. But I want to just sort of acknowledge, for us to do, since 2012, that's a crazy number. We've done 500,000 hours of coaching. Wow, that's I mean, that's just a crazy number. It's expensive. And sometimes that's really mundane. The same thing David's doing, right sizing a loan. But sometimes it's saying, I think you need to take a second shift so you can build up a couple of months cash reserves. Sometimes it's helping people repair their credit history. That's really expensive. So if we want people who are working for the fire department, people at 30% of AMI or lower, there's got to be a way to pay for that. You can either pay for it in interest rate. You can do that to, whatever, another 150 basis points, and it could be, some sort of subsidy. But 500,000 hours, that's just since 2012. And I mean, we're not doing what we're doing, and our loans aren't performing without that. I don't know, if you have EAP at your office, raise your hand. Do people have that? The services? Okay. Well, we have borrower EAP for everybody that's a home borrower. Like, that's really important in terms of these loans performing. So again, I don't know, we probably need an array of solutions for people at different income levels. My organization, let's say that you were, Mackenzie Scott, you made our balance sheet 100 times its size. We still probably couldn't serve everybody that needs to be served. Like, we're not going to do the cross mods, the double wides, $250,000 and greater. I mean, we really want to focus on this different income levels. So we probably need tools, for Cascade, and we probably need tools for organizations like CDFIs that are really trying to serve different markets. And we're working with new Americans. Like, what happens if we want to work with someone who's not legally present? That defies some of the constraints, of some of these federal programs.
So, Dina, I know you're at a totally different point in your program, but do you want to talk a little bit about how you're thinking through some of these issues?
I do actually want to just come back to what Steve was just saying. So, look, generally speaking, it's been our experience that folks who are at the lower income band have to be good money managers, right? They have less to work with, and they do a really good job. And there's sort of a lack of intuition about how we think about creditworthiness. One of the things we tried in the leasehold mortgage, which I'm now calling our pilot that preceded what we're about to do for personal property loans, was something called Second Look. So we ran everybody through our normal underwriting process, and those that could not get to yes, mostly it was not DTI driven, but right, we don't use a credit score, but just we're sort of lacking something that got through the non-manual underwriting. We would run back through on this sort of more intuitive chart that we created, right? So it was a scale of like you had to earn 7 out of 10 points, and you would get 5 points if you pay your rent on time. It can demonstrate that for the last year. And so we were able to qualify a lot of exactly the population Steve's talking about, much lower income folks who actually demonstrated good money management practices, but would have normally not been eligible for a mortgage. We struggled a little bit getting our insurer to agree to this, but we did. And we actually put up a loss against our own insurance company to get them to go along with that. But the performance was the same, whether they got in through our normal underwriting standard or whether they got in through what we call first look. We're debating how to sort of make that true in what we're about to do with the personal property loans. But I do think, what Steve is saying is correct. There is just a population, and unfortunately that population is growing because the cost of housing in New York has just gotten so insane. It does not matter whether you're in New York City, which is the worst, or whether you're in Rochester. A single family home to build now is costing us on average about $450,000 in a market where that home will appraise and sell for about $200,000. So we have a $250,000 gap on every home we build, assuming that's even affordable to the buyer. So we see this as really, really critical, and serving the people, I don't know if we'll go as low as 30, but certainly below 80, 60, 50 is the target market that we're sort of trying to serve with this new product. And I think we have to be a little less rigid, at risk of freaking you out, about about how we think about creditworthiness.
Oh, Todd, did you have something you wanted to add? Yeah, okay, looked primed. So we've already talked a good bit about some of the hurdles. Are there any other components to hurdles you all face in your business, your program, or how you're working to solve them? Or if you solved something really important and you want to share how you worked through that?
I'll add a couple of the really big hurdles. They are, sometimes they seem insurmountable, but it's my job to pretend that they're not until we finish. We have a very concentrated market, and we have a program that's at HUD that's badly out of date that I think really could fill this role. But once you start looking into all the people you need to get willing to work with you, like it does, not only do you need to attract lenders, but servicing these loans is different. HUD has a very specific, actually, I would, speaking from my Title II side, I would say not particularly generous loss mitigation suite. The programs don't allow sub-servicers presently. There's a whole lot of issues about, people who would want to originate these loans but not service them. Who can they sell it to? What can they do? There's also, we have to attract issuers to the Ginnie Mae program. So right now, Title I loans go into separate manufactured home-only Ginnie Mae pools, which have the government guarantee, which should give them, some level of liquidity. But we've still found that the market for these securities, it's a bit untested, even though we've tested it many times over the years. We don't really know where the interest rates are going to come back if someone were to originate a pool of, you have to put $1 million of them in a single security. If someone were to go and sell one of those, we don't necessarily know who would buy it. There are some investors who have, specific interests, and, we're hopeful that their demand for these securities will be as wide as we're able to issue, but we just don't know if that's going to be the case. And so, I feel like all of these lenders have kind of come up with their own solutions because the federal government for so long ignored this problem. And, kudos to the folks like Todd, who I don't know if Todd is, just really by the book and doesn't like credit underwriting exceptions, or if this is, what you have to do for your investors, because, you went out and did what no one else has done, which is create a home-only security that was rated by the rating agencies. And so, everyone has their way that they're making it work right now. The trick is, can we get all those interests aligned and kind of create a wider scale program that'll really serve the borrowers that we wanted to serve.
Yeah. Oh, and actually, sorry, before we go into that, can I get a quick time check? How much time do we still have left? I want to get to make sure I pick up some questions. 5?
20.
Oh, 20. Great. Go for it.
We do one of the same things as Dina, and I want to mention a little take, and maybe we think it's really important. We do a homeowners assistance loan for anybody that's from 0 to 30% AMI that covers down payment assistance, closing costs, and it sits silently until they sell their home. And that seems to be, a really critical piece for us. But I want to talk about like a typical problem that we face, because I don't think there's anything sui generis about New Hampshire in this regard. And it's funny, I'm looking at Jeannie right now. We organized a co-op in Conway, New Hampshire. The buyer, got the wrong realtor and they didn't bid enough, and the residents were able to organize. It was really lucky. Well, it turns out that the previous investor owner had been raising rents for years, but deferring maintenance. The homes there use on average of 500 gallons of water a day. Like if you have a 2,500 square foot house, or 3,000, you probably use 120 gallons of water a day. So think about if you're at 30% of AMI or lower, which is really our sweet spot. I mean, that's an exogenous pressure that we do all the same stuff in terms of looking at everybody's finances, but how do you solve for that? So we could lend them money to do the infrastructure improvements, but they don't need more debt because that just makes their rent higher. So we have to work and try to get CDBG grants, the stuff Jeannie has done for years. How do we bring in grants to those parks? Because you don't want the terminal rents to go higher. And I could spend 2 hours, and as Jeannie could, just telling you stories about how these deferred maintenance issues. And it's at the risk of being the apostle of the obvious, it's really expensive to be poor in America. Whether it's subprime car loans or, high credit card bills, there are all these sort of other pressures. So, and even if you do your underwriting terrific, there are all these other pressures, but and I'm glad, like, if New Hampshire had someone like her sort of putting these pressure on the investor owners, not just the cap, but on sort of having to keep up on their maintenance. Things like that are incredibly important, and they just don't exist, even in a state as strong as ours with protections for manufactured housing residents.
Yeah. So sort of exactly to that point, I think this is sort of our anxiety right now is about how to bring the existing park owners into sort of our, they're generally speaking, and this is a bit of a generalization, but there's sort of two types of owners that we're running into. So there's the old school mom and pops who've been around for years. Some of the parks are great, some of the parks less great. Some are trying really hard, some trying not so hard. And they are generally skeptical of government. Right. So at first they hear about our program and we can give you a grant to fix your infrastructure and get your roads and your water under control and your septic back. And then you ask them for like a driver's license and they're like, get off my land. Right. So it's a tough population to sort of pull into your world. We are trying, and we've actually hired through a grant program 4 of our nonprofits who do sort of community outreach across the state to start go and try to socialize what's coming to the park owners to sort of onboard them in advance. But then on the other side, frankly, and again, sorry, this is a bit of a generalization, but for a minute before we had the rent control in place, we saw a lot of like big corporate, fairly predatory, corporate ownerships coming in and buying up every park that they could get their hands on. Their goal, stated in their podcasts that they're happy to put on air, is to just raise rents and keep people trapped. And so that's also a population that perhaps they're willing to work with us, but not in reverse. So we are struggling to sort of figure out how to find a large portion of these 2,000 parks need to be participating for this to be successful. And we're really focused on how do we do that. There is an owners, it's like a trade association of the owners who's been great, and they've been allies to us, and we go and present at their conference every year. And they're trying to bring the message that we're not scary and we can be trusted to work with and be reasonable. But I do think that is going to be our big challenge in terms of getting this really scaled in New York.
Yeah, appreciate those comments. I just wanted to mention that we lend into many parks across the country. And while there are certainly some bad actors that do what you're talking about and have those podcasts, I just want for the audience, the vast majority of park owners don't do that. Yeah. And so I just want to make sure that's clear that loans that you make into communities, whether it's the largest 10 community owners in the country or even a bunch of the private equity owned ones, you don't run into that issue so much, but bad actors exist, and just want to make sure people understand the nature of the sector.
Sure.
I have to say, I don't share Todd's perspective. Literally you have things like the retirement system for the state of Washington public employees that have a company that sort of buys parks. So literally you have retirees in the state of Washington basically displacing retirees in New Hampshire, because the returns are so high. And I think for us, the gloves are off. We're trying to, I try to hire, right now I'm trying to find the meanest civil rights lawyer I can to join our staff to sort of defend, because investor owners in New Hampshire, the residents have a 60-day right to match the offer. But if an owner sort of ignores that, it's very hard for the residents to file suit and whatnot, and the penalties in our state aren't enforced. And also, if the owners decide not to, if the owners do sell the residents somehow have to pay the other owner for their pre-development due diligence. So there are real penalties there. So I think at least in New England and Vermont and New Hampshire, we're seeing a lot of bad actors in terms of private equity and coming into the system. And again, I want to mention the irony of retirement systems, really going after our retirees.
Great. So I want to make sure that I get a chance to get to some of the questions from the audience. And just as a reminder, you can put in your questions through Slido, which online you can see, or if you're in the room, you can see it at the bottom of your QR codes in front of you. So one I'm going to just take real quick, asked to explain the contract for deed and rent to own in more detail. If the question is, their transactions don't result in a mortgage and therefore exempt from lending regulations. Is that right? So great. I wanted to just clarify a little bit. So, right, these are not mortgages, so they don't fall under mortgage protections. The other component here is that when folks own a home as personal property, if the state laws are for real estate, then it's likely that those homes under contract for deed or rent to own wouldn't fall under those laws. So it's really troubling that even in states where there are laws to help protect people, if it's a personal property, it might not fall into that. And there really are very few federal level consumer protections. So when we think about mortgage or even personal property loans, there are a lot of federal level protections that are built in and so apply across wherever you live in the United States. But that's just not the case with those other kind of contract financing sort of arrangements. So that's just something to clarify. Does anybody have anything else to add on that piece? Sure.
So I do want to say this was a big issue in New York, not just frankly in the manufactured home space, but in the single family home space. So contract deeds, very predatory, very underregulated or not at all regulated. I will say we had a lot of success, and I used to work for the Attorney General in New York. There is a whole group now within that office that really focuses both on manufactured housing, but also on this sort of contract deed scamming. And there was a big lawsuit brought by threatened by the Attorney General's office that led to a consent, like an agreement, in which I think 16 different, park owners sort of had to agree and sort of give up this predatory contract deed behavior in the manufactured home parks. So I would say if you have a functioning good attorney general in your state, which we do, and they get involved, it made a big difference for us.
Great. So another question here is, why haven't other states adopted the New Hampshire model of automatically titling manufactured homes as real estate? And if other states pick that up, would that resolve a lot of the financing challenges? Steve, you might be best positioned. Well, I don't know if others have views on this.
I don't want to say anything uninformed.
It's totally fair. Yeah.
I don't know the real answer. I believe it would. I mean, I think it's really the key to, our success, as well as the 60-day notice, that residents have 60 days to match any offer from another buyer, even though the law needs strengthening and protection. I think that we were able to do what we do because of a great moment 41 years ago, and we really organized successfully. Jeannie, Wright, and I were talking this morning about how change happens and occurs, and there was some very negative legislation that was proposed in New Hampshire, and the Democratic Speaker of the Senate, said to me, well, you don't know how many people came to my office crying about the unfair co-op rules. And I said, how many? Just how many? And it turned out 3. We have 9,000 people in functioning co-ops in New Hampshire, and 3 people came. And so, of course, we brought 150 people to the legislature to the hearing, and they were screaming, clapping, and doing a certain amount of crying, and we were able to reverse the negative legislation. But I say that, and I really think that's how this change sort of occurs on a state level, is it takes whether it's a Dina or somebody in a state sort of organizing with residents, and you're going to hear from a bunch of residents today at 1:15, and I think that's really the powers. I think that legislatures really do respond to human beings being brought there, because I absolutely guarantee you that the park owners have their own very expensive lobbyist, and 100 people will trump even the most highly paid lobbyists, because nobody right now wants to be branded anti-affordable housing. And so we are really using that to our advantage, on both sides of the aisle.
I wanted to throw out one other thing on the question of titling and automatic titling. So manufactured homes tend to be much more affordable, but our research has really shown that small mortgages are especially hard for lenders to make and borrowers to get, especially when you get certainly under 150,000, but especially as you get down into under 170,000. So the titling component is definitely a piece here, but thinking through how to ensure that lenders can also make those small mortgages is also key, because you can have real estate, but if you can't get the mortgage at all, now we still haven't solved the problem. Now folks can't get a personal property loan and they still can't get a mortgage. So that's just one thing that we really have to keep working on. Todd, did you have something else?
Yeah, just to add that we're highly regulated by various institutions that, we adhere to HOPA, we adhere to all residential lending laws across, not all, most lending laws across chattel and land home. So our cost to originate a loan is quite high. It costs us a lot of money to go through every loan. So to reiterate Rachel's point, making the math work, we want to make math work. We're motivated to make math work, but as the balances get lower, it just doesn't. And so you can't have everything. You can't highly regulate an institution and yet expect them to make a loan for $40,000 and make the math work.
Yeah, we're sensitive to this. And I think what Steve said was important here too, which is we are going to, in the first instance, rely on probably 2, maybe 3 CDFIs as the originating lenders, because we do not originate loans right at the state. We're like Fannie, we purchase loans. But even for the CDFIs, who obviously are doing this out of mission and, may be able to raise like slightly less expensive capital, we are cognizant of the fact that it is very hard to make a lot of $80,000 or $50,000 loans. And yet in many cases, that's what the borrowers we want to serve can afford, right? So it's not always necessarily a new home, which is now also getting a little expensive, even in the manufactured housing space. So, we're toying with different ideas, like, do we need to increase the points that we pay lenders for originating? Do we need to increase the servicing fee that we pay, because we'll also have our lenders do the servicing and the default servicing? We have to then raise money for that, right? We can't just pay for that out of our bonded capital. But we are sort of open to thinking about how to entice more lenders into the space, particularly mission-based lenders like CDFIs, through slightly richer origination terms.
And I was gonna avoid speaking, but I shouldn't, because FHA earlier in the administration actually did a whole request for input on the small dollar mortgage issue, and we received really, really thoughtful feedback from parties in the lending industry, nonprofits, kind of some governments as well, kind of weighed in. That it hasn't resulted in a whole lot. FHA has gone to Congress and asked for the authority to be able to pay an incentive to originators for small dollar loans. And, we haven't put all the details of what that would look like in the legislation. But Congress just doesn't seem to really want to give us that flexibility. And so it's hard to figure out exactly, you don't want to let, there's a reason why we have caps on fees. There's a reason why we're concerned about, is the consumer getting a good price? Are they getting a fair deal? But, if you write your rules too strictly, you can just end up hurting the population that you actually really want to give high quality, affordable credit to. So it's very much an issue that the federal government would like to figure out what it can do on.
Great. Do we have time for one more question? Oh, okay, great. So how can we improve underwriting for manufactured home loans and scale up personal property lending? Manual underwriting is costly for lenders to participate in this space. So I think, this is kind of thinking through that secret sauce again, like manual underwriting is great, but it costs a lot. Can we automate it more and make that work?
Yeah, personally, I think I would love if there are both options. I think it's great that we do, mortgage lending in such an automated way in this country, and that the vast majority of things go through, desktop underwriter or loan product advisor. But it doesn't serve everyone. And I think honestly, on the real estate side, we might have a number of. Most lenders are very skittish about doing manual underwriting. And the people who have survived in the home only space, that's not their perspective. And I give them a lot of credit for that. I happen to think we're probably not going to have, a program where you have 75 originators who want to originate FHA Title I loans if we're only going to have manual underwriting. I think manual underwriting will work for some people, but if we want the vast majority of financial institutions to offer these loans, which is part of our vision, I think we need to have an automated option. And so we're working to build that at HUD based on that data set that I mentioned earlier that we have from our previous Title I loans. And, hopefully there'll be more announcements coming about the ability to do automated underwriting in the Title I program. And hopefully I'll still be in government when that is announced.
I think among those of us that are doing this work, we need to share our data more and have more conversations about what matters. You always want to have the manual underwriting option for those people that don't fit the box. A third of our loans are people with below 620 and they seem to perform well, but that obviously is not the indicator. Like what are the terms people are doing? Where are you in terms of LTV? It's one of the things I argue most with my staff about is, debt to income. We have a maximum of 50% debt to income. I don't know if I'm personally comfortable with that. I sort of look at it. I'd probably rather have that lower and go higher on other things. I think I'd rather have a lower debt to income and a higher LTV. We're capped at 95%. And things, as Dina talked about, the delta between cost and value right now is crazy. It costs much more. So I think some of that could help us at least come to some understandings about what matters in terms of performance, both for non-accrual and also for those that actually, go into foreclosure. I think that would really help us get to a place where you could at least automate 70% of the loans or something of that nature. We're looking under the hood.
I personally think it's great that you guys are able to do it. It's obviously expensive to do it. You have a different clientele than I think we do. So perhaps it makes a lot more sense there. I do fear if the FHA were to come out with a program that would work, that then you're going to have lenders doing disparate things with loans, and then all it takes is a couple of bad actors to ruin it for everybody else. And so having really talented underwriters doing manual underwriting is a great thing, but unlikely to happen at every lender participating in such a program. So I think, as you point out, as you get to a little higher income, there's probably more guardrails you can put on the lending to get the vast majority of the borrowers. You're going to miss some for sure. Unfortunately, I think that's sort of a necessary evil.
No,
You don't have
we'll get back to you.
Okay. I think that, we have time for one more question. Okay, this last one's for Todd. Can you elaborate on this secondary, Todd, can you elaborate on the secondary market for manufactured housing loans? Roughly how many issuances and how many lenders selling in the secondary market?
All we can see is in the public domain. So what happens in private, we don't know. We are the only ones to come to the public markets and do a securitization. There is one in the market right now from another lender. I don't know if it's going to succeed. I think it will. A smaller one, so that'll perhaps be the second one. It's a really small market. And then there's a home loan market as well, but also impossible to tell how much goes on there. But there's some loan transactions there, but that's inefficient at best. I think the issue that presents is that liquidity in the securitization market is not great. So if somebody buys our bonds, there's not a lot of people who know them. And so people need to get rewarded for a higher risk premium for that. It's not because of credit risk, it's liquidity risk. And that's a real thing, and it's quantifiable, and in different points in time, it's huge. 2022 and 2023, there was a huge number, which made it very inefficient to come to market, which brings back the Fannie, Freddie, and FHA, because they can take out that liquidity premium. And we didn't talk about it, but I think the answer in the Fannie and Freddie market is that we're happy to keep the credit risk. They just need to take down the liquidity risk. So there's a CRT construct, credit risk transfer construct, that works in that market. And those of you that are familiar with it, is basically Fannie and Freddie are guaranteeing the top of the capital structure, the really no risk part. And then they sell off the bottom piece to those that want to take that credit risk. we're happy to take that credit risk. We love the credit risk of these borrowers. We know what it is. It's really getting rid of the liquidity risk. And that's what we need partners to do, whether it's Fannie or Freddie, insurance company. It used to be the monoline insurers, which obviously have a bad name today, but that used to happen as well. There just needs to be another construct, whether it's FHA, Fannie or Freddie or something, to take down the liquidity risk. Credit risk is good.
Great. Thanks everybody so much. And thank you to all my panelists for their deep knowledge of this space. This panel is responding to threats to the continued affordability and livability of manufactured homeownership. I know that's a mouthful, but that is sort of our mission statement today. If you could please take your seat so we could proceed with the program. Thank you. All right. So hello again. In case you joined us late, I'm Eileen DeVringy. I'm the Community Development Research Manager here at the Federal Reserve Bank of Philadelphia. So for our second panel, we're going to switch gears from talking about access to manufactured home ownership to looking at some of the challenges affecting existing manufactured homeowners. I'm going to start by providing a broad overview of these challenges, including the findings of some of my recent work looking at land lease communities in the Philadelphia Federal Reserve District. Then I'll be joined by this panel of experts who have experience working on state and national policy, as well as on the ground with manufactured homeowners, for a conversation about potential responses to these challenges. As always, the views expressed in this presentation are mine and are not the Federal Reserve Bank of Philadelphia or the Federal Reserve System. So I want to start with some context on why we're kind of specifically concerned with preservation in the existing manufactured housing stock. It's worth noting that overall manufactured homeowners are significantly more economically insecure than comparable site-built single-family homeowners. As you can see here, almost 2/3 of manufactured homeowners have incomes below $50,000 compared to less than 1/3 of site-built homeowners. Additionally, almost half of manufactured homeowners have incomes 200% or less of the federal poverty level. So this illustrates the important role that the existing manufactured housing stock plays in providing housing, and particularly in providing home ownership opportunities to more modest income households. I also want to talk a little bit about housing quality and home repair issues in owner-occupied manufactured housing, but I want to be very clear that sort of despite a lot of negative stereotypes, there's nothing inherently low quality about manufactured homes. There's plenty of evidence that modern manufactured homes compare very favorably to site-built homes in terms of quality. But while the quality of new manufactured homes has increased significantly over time, repair needs are still common among older units or units that might have been improperly installed. And this is especially true for units that were built prior to the National Manufactured Housing Construction Safety Standards Act, which is often referred to as the HUD Code, which established the first federal kind of minimum quality standards for manufactured housing. Additionally, manufactured homeowners face a lot of additional barriers to making repairs to their homes, and that's something that we'll discuss further on the panel. And so accordingly, we do see elevated rates of unmet home repair needs among manufactured homeowners, and particularly among lower income homeowners who are more likely to live in these pre-HUD code homes. Next, as extreme weather events have become more common, the vulnerability of manufactured homeowners to natural disasters has become an increasingly salient concern. Manufactured homeowners are almost twice as likely to report that they live in neighborhoods that are at a high risk for floods or other natural disasters compared to site-built homeowners. Again, the age of the manufactured home is a really big factor here. There were updates to the HUD code in the 90s that improved the resilience of the homes to high winds in particular. But again, much of the existing stock was constructed prior to that. A compounding concern here is that manufactured homeowners are much less likely to have homeowners insurance than site-built homeowners. This is in part because a lot of these homes are purchased in cash. And that suggests that weather-related damages are going to have more kind of financial risks for these homeowners. Lastly, manufactured homeowners who live in land lease communities may be at heightened risk for displacement if the damage from the natural disaster sort of induces their community to close. So speaking of land lease communities, this is a segment of manufactured homeowners that faces a lot of additional affordability and livability risks that are kind of specific to this split tenure status. So as sort of referenced earlier, these are homeowners who own their structure, but they rent their underlying land. And over a third of manufactured homeowners live in a land lease community. Oops.
Sorry, didn't mean to move on to the slide yet. Overall, manufactured homeowners who live in land lease communities are somewhat lower income than manufactured homeowners who own both their home and land. And the most immediate risk for a lot of these households is the risk of unaffordable increases in lot rents. So this can be driven by a variety of factors: market pressures, changes in ownership, the need to finance repairs or improvements. As I alluded to on the last slide, land lease homeowners are at risk of displacement if the community owner opts to close the community. And that can happen, as a result of natural disaster. It can also happen because the site's being redeveloped, or because the community has been sort of regulated out of existence. Relocating a manufactured home, it's worth noting, is extremely financially burdensome for a lot of manufactured homeowners, and a lot of older homes can't even be moved safely. So in the event of community closure, those households are essentially out of their home. Additionally, a lot of land lease communities were built 50 plus years ago. We heard a little bit about this on our first panel, and many have aging infrastructure and significant deferred maintenance, particularly related to water and sewer systems. And then lastly, a lot of the resources and programs that are designed to help low-income homeowners often exclude manufactured homeowners in land lease communities. They might not cover homeowners who finance their homes with those personal property loans, or they have eligibility requirements that sort of preclude their use by people on leased land. So to return briefly to the topic of lot rents, I just want to emphasize how central these are to the overall affordability of the land lease arrangement. Land lease homeowners, as we can see here, are significantly more likely to be cost burdened than manufactured homeowners who own their lot. For almost 2/3 of land lease manufactured homeowners, lot rents make up the majority of their monthly housing costs. Again, a lot of this is because so many of these homeowners have purchased their homes in cash. But even when I looked at personal property loans in the Philly Fed district and compared the kind of typical monthly payment we would expect for those to kind of typical lot rents, they were comparable amounts. So for almost all of these homeowners, whether or not they financed, lot rents are a huge portion of their monthly housing costs. Lot rents range pretty widely across different market contexts. As you might expect, they are much higher in expensive housing markets like on the Pacific Coast. They are lower in less expensive places like in the Midwest. We also see in the most recent available data that lot rents continue to increase at a fairly high rate, even as we've seen sort of more cooling in the site-built rental market in terms of rent increases. So these next couple of slides draw on my recent work looking at land lease communities in the 3 states of the Philly Federal Reserve District. Those are Delaware, New Jersey, and Pennsylvania. These types of communities are generally not well captured in existing public data sets. And so to help fill that information gap, I pulled together a variety of different data sources in an attempt to compile as complete as possible an inventory of land lease communities for each state, including where the communities are located. I found that these communities were present in a wide range of market contexts, maybe a wider range than a lot of people would expect. And I think it's useful to examine those different contexts as we think about different preservation strategies. So first, I found that a large share of these communities were located in what the census considers to be urban areas. So the share ranged from about half in Pennsylvania to around 3/4 in Delaware and New Jersey. Even though the census describes these as urban areas, I think most of us would think of them as suburban and exurban areas, where they contribute to sort of the unsubsidized low-cost housing stock in a lot of these kind of metropolitan markets. You can get a sense of the distribution here from this map. This is roughly the Philadelphia metropolitan area. The kind of darkish gray-blue shading here are areas that the census has designated as urban, and the points represent communities kind of color-coded by size. So these are areas where tighter demand for home sites and the demand for housing generally can help put some upward pressures on rents. Of course, a significant share of land lease communities are located in rural areas where they often make up a larger and more visible share of the manufactured housing stock compared to urban areas, or of the housing stock generally compared to urban areas. So this map is of some predominantly rural counties in central Pennsylvania to give you a sense for that. I found that rural manufactured housing communities were less likely to be large and more likely to have a significant share of their sites vacant. Suggesting that there's sort of softer demand for these communities. And since home site vacancy translates to lower revenue for community owners, we might be concerned about issues related to deferred maintenance of community infrastructure, particularly since a lot of these communities have sort of private and on-site water and sewer systems. And then lastly, there are some particular preservation challenges for communities that are located in seasonal or vacation destinations where there's strong demand for vacation homes, but also a large share of year-round residents who work in sort of lower paid industries. You can find examples of these communities all over, but I think one of the kind of most prime examples is Sussex County, Delaware, particularly the areas around Rehoboth Bay, which is a major summer vacation destination and is also home to a large number of pretty sizable land lease communities. So we're going to explore the dynamics of this a little bit more in our panel discussion. So thank you. That's my quick overview of the major preservation challenges in the owner-occupied manufactured housing stock. We'll now hear from our panelists about how they've responded to these challenges from a variety of different angles. Once again, I encourage you to submit questions via Slido. And so let's get to the panel portion. And with that, I'd like to invite our panelists to introduce themselves and provide maybe a little bit of background on their experiences related to manufactured housing. So start with Katie.
Good morning. Thank you for having me today. My name is Katie Millard. I am the Director of Development and Advocacy at Sussex County Habitat for Humanity. For those of you not familiar with the geography of Delaware, our service area is the southernmost county in the state of Delaware. And like Eileen said, we serve areas from the coast, high cost areas over to the west side of Delaware, which are more rural and lower income areas of Sussex County. Many people might be familiar with Habitat for Humanity for our flagship program, which is affordable homeownership, but we also have home repair programs. So we have a program called the Healthy Home Repair Program. And through that, we serve low income homeowners throughout the county of Sussex. And you might be asking, why? We are familiar with your home ownership program. Why home repairs? Well, Sussex County has a very high home ownership rate. So a lot of people already own their own home. However, there are a lot of people in Sussex County who need a lot of home repairs. A lot of homes are substandard and a lot of homes are making their inhabitants unhealthy and sick. We have found that a large percentage of those homes are manufactured homes. So a lot of our homes that we actually touch through this home repair program are manufactured homes. One thing that I just wanted to touch on before we get to Jim and before we get into our panel discussion is that we have seen a huge increase in need for home repairs for manufactured homes. A lot of our home repairs are up to $20,000, which is a huge amount for people who are lower income. And a lot of those repairs are necessary because if they're not made, it's going to impact the entire system of the home. So if we need to replace a roof or if we need to repair a roof, that will help so that the entire floor doesn't fall through, right? So we've had people go into homes for home inspections and they've actually fallen through the floor before, because if there's a leak, then the particle board floor will deteriorate and right through that floor. So I'm excited to go more into this and thank you for your time.
Jim.
Great, thank you. My name is Jim Gray. I'm at the Lincoln Institute of Land Policy, where we have the Innovations in Manufactured Housing, or I'm Home Network, which is really the leading national network of people who are focused on mission-driven affordable housing. Manufactured housing, I'm sorry. You know, almost all manufactured housing is relatively affordable, but our focus is particularly on helping those who are trying to serve a mission population, people at a specific income level. And then the other part of our work is the Underserved Mortgage Markets Coalition, where we're trying to deliver the financing into manufactured housing that is so critical and was, I guess, more the focus of the first panel. The whole thing about lot rents is such an important part of manufactured housing. And one of the things that came up on the prior panel was certainly this problem of predatory treatment of lot rents is a very serious problem, and it's one that we have tried to tackle directly at the Lincoln Institute with a program that we have that's actually called Who Owns America? And we're trying to map through our Center on Geospatial Solutions all kinds of efforts by equity investors to get control of various kinds of property. And of course, one of the prime pieces of this is manufactured housing communities. And so this is a big problem, but in fairness to manufactured housing owners, there are more community owners who are not on the side of predatory investment than there are who are actually engaged in this predatory activity. And hopefully there will be a chance for me to go into a little bit more depth on that, but I'll pause there.
We're also very fortunate to be joined today by our virtual panelist, Victoria Clark-West. Tori, please.
Hello, everyone. Victoria or Tori Clark-West. I'm the Executive Director at North Country Cooperative Foundation, or NCF. We are a nonprofit based in St. Paul, Minnesota, and we're best known for our work in the preservation of manufactured home communities through cooperative ownership. And we are a member, one of the founding nonprofit affiliate members of the Resident-Owned Communities, or ROC USA network. And we've been doing that work since 2004, the preservation of manufactured home communities. I have been at NCF for about 8 years and been the executive director for 3 of those years. So excited to be on this panel and chat more about what we're doing here in the Upper Midwest to create an enabling environment for preservation of manufactured housing. So great to be with you.
Great, thank you. So let's jump right into it. So Katie and Tori, both of your organizations work directly with manufactured homeowners in your respective regions. We know that home repairs are a major challenge, as Katie sort of alluded to earlier, and also for lower income homeowners across the board. But what are some of the specific barriers that manufactured homeowners face, and how have your organizations responded to those challenges?
Some of the specific challenges that we see and challenges around home condition are lack of contractors. So I think there's a lack of contractors just generally across the state of Delaware, but probably across the entire country. We have found that when we are in contact with the manufactured homeowners who need home repairs, they don't get calls back. If they do get a call back, the contractors do not show up. If there is a meeting, if they come out once, they don't come back out again. So there's a real lack of availability of contractors for our manufactured home clients. Additionally, a lot of the repairs are very expensive. So if that contractor does come out, oftentimes the homeowner cannot afford the repairs that are necessary to their home. So what we've done is we act as the intermediary for our clients and the contractor. So we've been able to acquire a list of contractors that we can utilize for any repairs, especially for manufactured housing. And some of those contractors are mission driven. Our vision is a world where everybody has a decent place to live. So they align with that and they want to make sure that everybody is living in a nice home and that their home is in good condition. We are also able to work on economies of scale. So we do approximately 80 home repairs a year. And that number of repairs allows us to work with more contractors because they know that they will have work. Sometimes the one-off repairs, people won't even get a call back. So that is very important for us as well. So the number of repairs that we're able to do and the mission alignment with those contractors. We also have to work with specific contractors because for manufactured homeowners, a lot of the parts are non-standard. So some of the windows are non-standard to stick-built housing, doors, pipes, roofs. There's a lot of differences between stick-built homes and manufactured homes when it comes to just the technique of home repairs and contractors that we need to make sure are working in those homes. So we are able to make sure that we are aligning with those contractors and they are able to make those home repairs. Another issue that we see in manufactured homes is lack of weatherization. So a lot of our homeowners are paying exorbitant amounts of their income towards heating and cooling. A lot of the homes don't have sufficient insulation. If they do, that insulation is starting to deteriorate because of water infiltration in the walls. So we're trying to work on that as well. We actually, in the middle of the pandemic, we were looking to see what additional programs we could offer to our clients, and we started a program specifically for manufactured housing. It was called the Insulated Skirting Program. So what we did is we offered to anyone who really owned their own manufactured home, we would put on insulated skirting around the bottom of their manufactured home to try and save on heating and cooling costs, and also, so pests couldn't get under it and, eat at the insulation under there, and make sure that we could insulate some of the pipes, because pipe bursts and pipe issues are also a big issue that we see a lot of the time. So the main issues that we have seen, we have tried to work on as a middleman to make sure that we are bringing the clients together to the solutions. And that also includes advocacy, right? So we have an advocacy program where we try and educate about the issues that we see every day on the ground. And we work with community partners. There are community partners in this room. And try to make sure that we are advancing legislation that could potentially help our clients.
Okay, thank you. Tori, would you like to add to that?
Sure. Yeah, I would echo everything that Katie underscored in terms of the issues, the kind of systemic barriers that exist for manufactured homeowners in terms of accessing quality contractors. I know I really want to commend Sussex County Habitat for serving as an intermediary, because that's definitely a key piece of the puzzle in having folks between the homeowner and navigating contractors and different financing programs. That's a really key piece of what's I would consider the enabling environment for doing this type of rehab work at scale with manufactured homeowners. And that's something that we've done a lot of work on. The work that we've done in Minnesota and Wisconsin is really around advocacy and expanding access to existing rehab programs. Or creating new programs when those existing programs can't for whatever reason be applied to manufactured homeowners in a land lease setting. And we've received quite a bit of organic outreach from municipalities and other local housing and redevelopment authorities and community development directors who are interested in leveraging resources that they've secured, housing trust fund dollars or pooled TIF resources to create rehab programs. So we're very excited that it seems that there's a lot of traction around interest in providing access to rehab, home rehab resources. Really, the barrier continues to be, and we're working on some creative solutions to this in our backyard on contractor training, as Katie addressed, getting contractors that are knowledgeable about working on manufactured homes and can navigate some of those sourcing of particular, sized windows and doors and things that are kind of non-conforming for a traditional stick-built home. The one thing that I would say that I think holds a lot of promise, especially in the resident-owned communities, the cooperatively owned communities that we support, is what we refer to as close proximity production of rehab. And this is something that's near and dear to my heart because we've seen good success with it in our sister organizations in New Hampshire, who have gotten large large awards for rehab, whether that's through the weatherization assistance program or what have you. And you can really make what I mean by close proximity production is the ability to both train contractors and do kind of like a block build. So you get a large enough contract for rehab that you can do close proximity production. That contractor, has a set amount of homes in the community, and they can be very efficient with their resources and their time. They can do lots of recycling of materials, and that's something that we'd really love to see replicated in our market, just because what we see in our cooperatively owned communities is about a third of the housing stock is those pre-1976 homes, and then a third is that other range between 1976 and those improvements that were made in the 1990s. And those are typically the parts of the housing stock in our cooperatives that typically need the rehab resources. One thing, just because we noted it in the preparation for this panel, that I wanted to underscore as we get approached by municipalities and folks that are interested in creating rehab programs, and I think Jim is going to speak to some of this later in the panel as well, is just the need to be really thoughtful about the protections, the consumer protections that are baked into home rehab programming, especially considering land lease communities where you might be doing home rehab or creating a home rehab program that you're going to be doing work in privately owned communities. And so we do a lot of outreach and education with different folks that are interested in creating these programs about how you might approach the landowner, because you need a partnership with the landowner when you're doing rehab at scale. You need to have that working relationship with the park owner, the community owner. And so being knowledgeable about what are the types of things that you could put in place in terms of, pad lease protections and other things, because you're doing a great service and you're benefiting the homeowner, certainly when you're doing home rehab, but when you stabilize the housing stock in a land lease community, that is also a benefit to the landowner as well. You're improving the performance of the overall housing stock, which is ultimately so there needs to be there's a dance in terms of owning the responsibility and the investment that's going in to those programs as well. So, and there's lots of creative ideas around that, and I think Jim will speak to some of those related to pad lease protections later on.
Thank you. So for some older homes that are in severe disrepair, the best option might just be complete replacement. Jim, could you talk about some recent efforts to establish or expand mobile home replacement programs and what state and local actors might want to consider if they're developing these kinds of initiatives?
Great. Yeah, thanks. So really sort of a bookend to what Catherine and Tori were talking about is the problem of severely dilapidated manufactured housing. And, we work on 2 or 3 really big barriers to broad adoption of manufactured housing as an affordable housing solution, but probably there is no barrier bigger than the problem of the perception that's created by the large number of dilapidated units that we all see littering the countryside, not just pre-HUD code homes, but really any homes much older than 1994, when the manufacturing standards got substantially better, are often in need of replacement. So what we have tried to do, what we're now trying to do is, probably many of you are familiar with this one-time opportunity that we have with the PRICE program, which is a $225 million appropriation. The funding deadline is about to close. Grantees can ask for up to $75 million. So the I'm Home Network is going in for a $70 million HUD grant to try to replace dilapidated manufactured housing units in 3 particularly hard to serve municipalities. And those are, we're working with FAHI, a well-known CDFI in Appalachia. We're working with CDCB, Come Dream, Come Build, in the Colonias region, border region of Texas. And we're working with Neighborhood Preservation Housing Services in the Inland Empire in California to replace units for farm workers. And so all of these populations are at very low incomes, and the people in these places don't, other than these financing partners that we have, the infrastructure is really not there to reach these communities. And so what we're hoping is that if our demonstration is approved and we can deliver replacement units to these places, that it will help to make the case for a broader price program so that more units can be replaced. And we think that really getting rid of a lot of the dilapidated housing stock will do more than almost anything that we can do to increase people's comfort level with manufactured housing as an affordable housing solution. And I'd love to talk about that more. And I will look forward later to getting into the Hadley stuff, but to the point we're at now, I wanted to talk about price.
All right, great. And I guess along the same lines as price, so in addition to repairs to individual homes, a common challenge in manufactured housing communities is deferred maintenance, right? Critical infrastructure. Again, we heard about this on our first panel. Katie, what are some of the common infrastructure issues that you see in manufactured housing communities in Delaware?
So in addition to individual homes, we do see issues with infrastructure, especially in more rural communities and communities that are not hooked up to municipal water and sewer. Just a few anecdotal instances that we have. We had one of our homeowners who was coming from a manufactured home community, and she and her children were not able to bathe in the water that came from their well because there was E. coli and bacteria in the well. So whenever they would bathe, it would cause a reaction on their skin. So they would have to buy bottled water, which is very expensive and is just increasing the cost to live in their home. Additionally, we have seen issues with septic systems. So a lot of the septic systems are not able to keep up with the number of people who are living in the homes and the number of units that are in the communities. So some of the communities have sewerage right in the yards, which is something that no one should live around and is a health issue. So a lot of the issues that we see revolve around, again, that issue of health and how where you live can affect your quality of life and your health. We also see some issues with roads. So, a lot of potholes, which can cause issues to cars. There's really a lack of sidewalks, which is a safety issue. And one other tertiarily related issue that we see to manufactured home communities is a lack of public transportation that goes to the communities. So if a resident does not own a car, it's very difficult for them to either get to their job or to get to any other daily living activity, the grocery store, to school, to anything like that. So there are very, very large issues that we see with infrastructure. And I'm excited about some of the new innovations that are coming out. I did hear on the first panel that some of the park owners are concerned about using some of those. So I look forward to hearing some of the on-the-ground work that my other panelists are doing and how maybe we can act as some type of intermediary between the park owners and different programs that are already out there.
Yeah, in that vein, Tori, the state of Minnesota has dedicated resources available to manufactured housing communities to address these types of issues. What are some of the common challenges that you see? Could you tell us about how those programs work and what motivated the state to make these kinds of resources available?
Sure. We've been advocating at the state legislature in Minnesota since 2016. And the first thing on our agenda as we started our resource advocacy efforts was focused on infrastructure, dedicated sources of grant funding from the state that the cooperative partners that we work with could apply to tackle major infrastructure projects, water, sewer, storm sewer, and roads being the most costly in terms of maintenance and rehab of private infrastructure. And in 2020, we were successful in getting the state legislature. We take our hats off to the Minnesota legislature for really trailblazing in this area. They created the Manufactured Housing Redevelopment Program, a program which is administered by Minnesota Housing Finance Agency. And that program had its first inaugural appropriation in 2020 of $2 million. And they did their first RFP for that program in 2020. And every year running, there has been an increase in the amount of grants deployed from that program. So in the last 4 years from that state infrastructure grant program, Minnesota Housing has deployed over $41 million in infrastructure grants to both cooperatively owned communities and private parks. So last year was their largest award year. They made over $20 million in grants. About 10 million of that went to cooperatively owned communities, and 10 million went to privately owned communities. That program comes with it comes with deed restrictive covenants. 25 years of affordability covenants come with that grant program, which limits rent increases in those communities to 5% a year. There's some other compliance related to that program as well. And the really deciding factor, I think, for in terms of what has moved legislators in Minnesota to make these types of appropriations and make this investment in these communities really is just about who is being served. There's I think in most communities, there's a rural-urban divide, and I think a lot of rural legislators are, always advocating. I'm from a rural community, are advocating for resources to reach rural residents, and manufactured housing, as you illustrated in your kind of preamble to this panel, manufactured housing provides a really critical source of the affordable homeownership in rural communities. So that was a huge compelling force. And then I think that the per unit investment in these communities, I'll give you one example. Our first large project that we helped one of our cooperatives in Worthington, Minnesota. This is a southwestern rural community in southwestern Minnesota. It's 106 units. 80% of this community is Latine, 20% is Southeast Asian. This is 100% BIPOC community located in Worthington, workforce housing located in the heart of Worthington, Minnesota. And that community received a $1.3 million state grant. That's a little over $12,000 per unit investment for the complete stabilization of the water, sewer, and road systems in that community. This is a community where the school buses and the trash and recycling collectors refused to drive through the community anymore because the condition of the roads were so poor. So residents in this community were having to haul their recycling and trash bins to the periphery of the community in order to get them picked up. That's how bad the conditions of the roads in this community were. So for $12,000 a unit, I'd say that's a astonishingly good investment.
Yeah. So I'll just quickly add, in our price replacement program, we are factoring in new septic and new wells for all these units. And so our per unit cost is a little over $200,000, which, in manufactured housing, that seems like a high number. But for anybody who's looked at like what it costs to build one door in a LIHTC project, it's still a screaming bargain. And so we think that the points that they've made about septic and wells is a really important part of a high quality replacement program.
Thank you. Yeah. So I want to return to this issue of lot rents, right? Kind of the big topic in the room. As we discussed, and as you've heard today, this risk related to rising lot rents is a huge challenge to the long-term affordability of this housing stock. And then one of the findings of my research that I highlighted earlier was that we see a lot of these different kinds of market contexts, and we might see those affordability pressures show up in different ways in different types of markets. And I highlighted Southern Delaware both because it's an important example and because I knew Katie would be on the panel today. Katie, can you tell us about what the kind of particular challenges of these pressures are in a kind of tourism and vacation-oriented community?
And in Southern Delaware, there are some protections for manufactured home owners for lot rent, and there are also a lot of non-protections for manufactured homeowners for lot rents. So I know that in the past, there has been legislation passed that does not allow capital improvements to be included in lot rent increases. And to get that passed, there is an annual increase of 3.5% that was guaranteed so that they could pass the capital improvements coming out of that. I know that there is a bill right now that is going through the legislature that is going to put a cap on lot rent increases. That has not passed yet, but that is something that they are trying to do in the whole state of Delaware, not just in Southern Delaware. And why is that important, right? So in Southern Delaware, if you can picture the southernmost area of the state of Delaware, we are right next to the beaches, and we go over to areas that are rural, that have a lot of farming, that have a lot of lower wage jobs. It takes about an hour to get from one side to the other, so we're pretty small. Along the coast, which is much more expensive, lot rents can be anything from $1,400 to $1,600 a month. On the other side of the county, they could be less. They could be about $600 a month. So the issue, number one, is that they are very expensive no matter where you are in the entire county, especially if you are on fixed income, which I know our clients are, a majority of our clients are retired or they have disabilities. So a majority are on fixed income. And the other thing that is an issue, especially in more expensive communities along the coast, is that, and going back to the idea of home repairs and the need for home repairs, people are being pushed out of their communities. So there's this idea that the manufactured home communities along the coast are for seasonal homeowners. So people are coming in, they're coming in for a few weeks during the summer, and it's their second home, and it's luxury, right? So what they're trying to do is make it a luxury community, right? So a lot of our clients that we are seeing, they call us because they get a notice from the HOA that there's an issue with their home, and if they don't fix it, they're going to get evicted. So the issue of home repairs is not just to keep them in their home safe, but also to keep them in their home so they don't get evicted. Because a lot of the issue, it could be as simple as power washing, and they can't afford to power wash their home, but they could be evicted for that. So we are seeing a lot of displacement, a lot of turnover, and there's really nowhere for people to go if they do get evicted from their home, especially if they want to live along the coast where a lot of the jobs are. So we're trying to help with that through home repair, and I know other organizations are trying to help as well. And I'm interested to learn a little bit more about what other areas are doing for that.
Great. Tori, have you seen sort of similar affordability pressures, different affordability pressures in the communities where you work? And what kinds of policy or programmatic tools have you seen as sort of important for preserving affordability?
Yeah, certainly with the rise and the kind of the consolidation of the ownership of manufactured home communities, the rise of private equity in this space has certainly given rise to substantial increases. I like to tell people, before I was the executive director at NCF, I ran our real estate division. So I was managing the actual acquisitions, cooperative acquisitions for the resident-owned communities program. And when I started in that role, just 5 years ago or so, it was pretty it was highly unlikely to see sales of manufactured home communities go for upwards of $30,000 a lot. Now, I would say that's more the baseline, and we're seeing even in urban communities, we're seeing communities trade for between $70,000 and $100,000 per lot. So it just, the prices of communities have gone up exponentially, which of course demands and necessitates higher revenue from the asset. So we've seen lots of rent increases, which has led to really what we refer to as economic eviction, essentially, of homeowners in these communities. So this has certainly been a part of our advocacy strategy. Is we believe that the surest way to ensure and preserve affordability in a community is to make it resident owned, is to take the profit motive out of the ownership of the asset, which is what resident ownership delivers. Obviously our advocacy efforts would really center around that. So 2023 was a big year for us. We passed a 5% tax credit for community owners who sell to the residents, which has helped increase some organic outreach from owners about interest in selling to the residents. In addition to we've had lots of innovations in creating enabling capital for resident acquisition, so that when they do have an opportunity to purchase, the residents can make good on that by having access to timely capital. So the State Housing Finance Agency is now providing acquisition financing on these. That is, you can't touch the interest rates from the State Housing Finance Agency, which has been a huge game changer in Minnesota in terms of creating an enabling environment. We've stood up. I think this is a really this is a big key for our sister organizations across the Rock USA network. Many of the network affiliates in this network have loan funds. Many of them are certified CDFIs, and they provide subordinate debt capital on the resident-owned acquisitions, which is also a key part of the enabling environment for facilitating cooperative acquisitions of manufactured home communities. But we're really laser focused on incentives, sale incentives for owners to convert to cooperative ownership. There was also a notice of sale provision passed in 2023, which requires community owners that are planning to sell the community to at least notify the residents. This is part of a growing trend across the United States. I think lots of states, there's this kind of growing trend for opportunity to purchase laws or right of first refusal laws. So this notice law doesn't go quite that far, but I think that was the hope of the legislature that tax credit and incentive, when paired with a notice law, would help at least start moving the needle in terms of creating more cooperative conversions in the state. So that's kind of been our focus as of late.
Excellent, thank you. So I do want to make sure that we get a chance to talk about the PAD site lease protections that you work
on. What fun is a meeting like this if no one says anything this provocative, right? So this is the part where I'm going to say a couple of provocative things. And my job before I was at the Lincoln Institute was I worked for the Federal Housing Finance Agency that regulates Fannie Mae, Freddie Mac, and the home loan banks. And one of my responsibilities toward the end of my time was to start the new Duty to Serve program that includes manufactured housing. So this will come back around, I promise, to PAD lease protections. But before that, I want to say something maybe it's provocative to my host, the Federal Reserve. In our world of community development finance, there's a ton of emphasis on the Community Reinvestment Act, and there has been since the Clinton administration. And the Community Reinvestment Act is really, really important. And so I'm not denigrating that, but something has happened over the last 30 years, which is the mortgage market has moved away from banks that are subject to the Community Reinvestment Act. And that market has moved to independent mortgage banks. And all of those independent mortgage banks are even more reliant on Fannie Mae and Freddie Mac than they were before, because it's so much harder to do private label securitization. And so one of my messages is that we really need to redirect more of our advocacy efforts from the CRA to focusing on where the money is now, which is really Fannie Mae and Freddie Mac. And so the specific thing about PAD lease protections when David Sanchez and I were at we're trying to figure out, well, what will we put into this duty to serve regulation, specifically about manufactured housing? So one obvious thing on the multifamily side was resident-owned communities, right? So we put that in there. We'll give you credit, Fannie and Freddie, if you do resident-owned communities. The other thing that we put in the proposed rule was minimum tenant pad lease protections. This was in the proposed rule, much stronger than what ended up in the final rule. When we put that in there, you would have thought Fannie and Freddie's heads were going to explode. I mean, and I can say this, not speaking out of turn as somebody, from what I know from working in the government, because there are comment letters on the proposed rule that both Fannie and Freddie filed saying you absolutely cannot choose pad lease protections as something for duty to serve. I mean, even if you could do it, it would cause the securities not to trade, right? So, and then to the point of, and so initially everybody said, Jim, you're crazy. Why are you putting this in the proposed rule? It'll never work. Nobody will ever do it. Well, so then along comes one of the probably the biggest company in the manufactured housing community space. And they went to the GSEs and they said, you know what, we want to distinguish our business from the bad guys who are doing all this predatory stuff, going around and buying manufactured housing communities, because we're not doing that. We're buying and holding. So from now on, all the loans that we sell to you, we want them to have pad lease protections in them. And so suddenly, this idea that seemed like the most crazy idea in the duty to serve rulemaking turns out to be the most popular thing. And both Fannie and Freddie embrace it and do it widely. And then FHFA says, well, now we're going to require pad lease protections on every single loan that Fannie and Freddie purchase. And so why this is important is that it demonstrates that if people can really get organized around how to get Fannie and Freddie more engaged in mission lending, it can really make a very big difference in the federal mortgage policy. So I would encourage all of you to really pay attention to these. Sometimes the details of these federal programs feel inaccessible, but they're really, really important. And it's really, really important to focus on the immense power that Fannie and Freddie have to change mortgage markets. That's my pad lease protection story.
All right, thank you, thank you. So we have just about 8 minutes left, and I want to make sure we get to some of the questions in the Slido. Again, please, if you have questions for this panel, submit those via Slido. So the first one here is for Katie and Tori. Before undertaking rehab on a home, do you assess whether the extent of needed repairs is cost effective compared to unit replacement? And then do you have a threshold for repair versus replacement?
Go first on that. So we do an assessment before we do a scope of work with contractor. We make sure we talk to the homeowner, and we actually go out with contractor and tour the unit with the homeowner. Most of our thresholds are grant dependent. So a lot of our home repairs are based on what we can and cannot do based on grants, and also caps based on the amount of money that we can spend on each home per grant. We do, if necessary, couple grants together so that we can increase the amount of work that we do per unit. We try to make all the repairs that we can. So we do not, Habitat does not do replacement. So what we try to do is we try and make sure that we can do all the repairs that we can that are necessary. There are some cases where we cannot because the home is likely to be condemned. So at that point, we would refer them out to other organizations, such as Sussex County Community Development could potentially help, or other groups that would be able to help. I don't know that there is a threshold, but there is decision making with the contractor and with our home repair specialist at the time when they're looking at the home.
Yeah, certainly there is a threshold. Our organization we just did our we're just getting into the home rehab and replacement world. We just partnered with a state agency this year on a very large EPA grant, which fingers crossed is funded, and that does that's a contractor. We applied to do contractor capacity building, home rehab, et cetera. In the course of writing that grant proposal, lots of hard questions came up about this topic of if you get into a home and it ends up being a candidate for replacement, what types of things can we do? So that is a quandary that I would, flag for everyone, that when you're contemplating a rehab program, you have to factor in that a certain percentage of the homes are going to not, they're not going to be candidates for rehab. They're going to be candidates for home replacement. And then what, right? Do you have enough per unit subsidy that you can make the new replacement home affordable to the incoming homeowner? I'd be curious to hear more about Jim and their price app on how they're tackling that issue in terms of keeping the home when it's replaced affordable. Or creating incentives. We've contemplated and toyed with the idea of having a title surrender program where if the homeowner, their home is, really in need of replacement, but they can't afford, we don't have the resources to keep the replacement home affordable to them. What are other things that we can do to get that household into a better housing situation and incentivize them to leave that dilapidated unit and get into a housing situation that's more appropriate and healthier for them. So it is a challenge of this rehab conversation.
Yeah, so I'll respond to that. The honest answer is that we're able to do this replacement program because the price subsidy is so rich and deep that it allows us to provide a very low income homeowner with a new unit at a first mortgage, either no first mortgage or a first mortgage that they can afford. And even at that, there are going to be some older homeowners who are going to say, no way am I going to give up my really dilapidated unit because I'm not willing to take on any more debt. But that's why it's really important that to help replace a lot of the dilapidated stock in manufactured housing that we get the price program to be made permanent so that there are subsidies to support this.
On a related note there, we have a question around home replacement and the difficulty of temporary housing for residents. Is that something that you've encountered in these programs? Well,
so, we're just applying for this. We have done some case studies on replacement, and temporary housing is one of the costs that goes into this, like $210 per unit to do this replacement program, but definitely temporary housing in the case studies that we have done has been one of the barriers to doing successful replacement.
We've contemplated two strategies that we've seen success with on home replacement. One strategy, if it's in a land lease community, if you have existing vacant lots, is to bring a new home in and have the homeowner move and then demolish the home on site or remove it, whatever the local ordinances allow. So that's our preferred strategy because there's no downtime. The new unit comes in, the homeowner is just able to move down the street to their new home when you have vacant lots that are available. In this grant that we applied for recently to the EPA, we contemplated also, we've seen this strategy used where a travel trailer or an RV is used. In Minnesota, we have to do this in the warmer months. We can't be doing this in the winter. But having a travel trailer that could, the homeowner could, and then you would rent an on-site storage unit. Folks could live and maintain living in the community. The cooperatives like that approach because it allows the homeowner to stay in the community. The kids aren't displaced if it's a family with children, and it brings the costs of relocate. If they're relocating and they've got temporary housing expenses, it brings the cost down. So that's been one. As long as we're sharing ideas on how to tackle replacement, because it's a bit of a pickle. Those are a couple of strategies that I would suggest.
it's great. Thank you for those suggestions. I think there are a few more questions in the Slido that are really great, and I encourage you to connect with the panelists during lunch or during a break to get at those. But I think we're going to close the panel there. Thank you to our panel.
So I'm very excited to introduce our lunchtime keynote. Chris Herbert is the Managing Director of the Joint Center for Housing Studies of Harvard University and a lecturer at the university's Department of Urban Planning and Design. His extensive experience conducting research related to housing policy and urban development, both in the US and abroad. His research focuses on the financial, social, demographic dimensions of homeownership, the dynamics of the rental housing market, drivers and trends in housing affordability, the nature and causes of racial and socioeconomic segregation, and the housing implications of a rapidly aging society. And on a personal note, I just want to say that Chris and his team have been really lovely to work with in these 3 recent manufactured housing papers that he's going to talk through today and that were funded by the Pew Charitable Trusts. So with that, I want to welcome Chris Herbert to talk through his research.
I'm really pleased to be here with you today. The title of my talk is The Potential and Challenges of Using Manufactured Housing to Expand Entry-Level Homeownership. So just to kind of frame this, we've been talking a lot today about existing homes and manufactured home communities. And the nature of the work that we've done in partnership with Pew has been much more looking forward is how do we expand the supply of manufactured housing to provide an entry point for people to get into home ownership. The self-promo here for the 3 reports, they're all available at our website, www.jchs.harvard.edu. We did a series of 3 reports, the first of which was to document the cost advantage of manufactured housing, and I'll talk about the details of that. The second then was to look at what are the barriers to expanding the use of manufactured housing. So a literature review and interviews we did with informed folks in the industry and in the policy world. And then the last one we did was to identify a few cases of organizations that are starting to make new inroads into expanding the supply of entry-level manufactured housing. So trying to hold up how folks are trying to overcome those barriers and give some examples of the work that's underway. So I'm going to, the gist of my talk will be to go over the findings for those 3 studies. I do want to give a shout out to Rachel, to Tara Roach, to Travis, and to Alex Horowitz, who's not here. We did this with financial support from Pew. But more than that, they were really collaborators in the project, helping to frame the research, helping to comment on both the approach and then the drafts. And they were really, really helpful in producing what we did. One of the first things we did was we were going to do this as one big report and drop this thing on your desk like a phone book. And Rachel said, 3 little reports might be better. And so I think she was right. So hopefully you'll get a chance to look at them and weigh in. So I'm going to talk about these reports. The first thing I want to start off with is a little bit of setting the table. So I'm going to talk about kind of trends in the market, trends in the manufactured home market, but also a little bit of the context about why affordable entry-level homeownership is so important today. So let me start there. So the Joint Center is pretty well known for our work on demographic analysis. And this is a pretty simple chart, but one that I think makes an important point about where we're going to see demand for housing over the next 10 years. So the dark bars here are the age structure of the population in 1-year increments as of 2022. And the yellow shaded area is what that population age structure is going to look like in 2029. So places where you see the yellow area popping out from the chart is areas where we're going to see significant population growth over the next 10 years. And where are they? The first one is the so-called silver tsunami. We're going to see the baby boom generation moving into those older age groups. And that's why we call it a tsunami, because it looks like this wave moving across the chart. But the other area there is between ages 30 to 45. And this is the millennial generation, which has been the largest generation in our country's history that had been centered in their 20s, but is increasingly moving into their 30s. And in fact, what we saw up until quite recently was that generation was, in fact, moving into homeownership, pushing the overall homeownership rate up. And we're seeing the biggest increases in homeownership among those under age 35. And so we're really at a time when the demand for entry-level homeownership is large and growing. And what I should also say is one of the things we've noted as we've been doing our analysis is looking at the shape of these generations. The Gen Z behind the millennials, which you can see here has a little bit of a hump shape here in their 20s right now, We've thought about that as a large but smaller generation than millennials. But in fact, because of immigration, that generation is going to be bigger than millennials. It's already growing faster. And so this wave of demand is not going to ebb. It's only going to grow bigger over time. So that's the first point, with the strong demand for homeownership. And the second point is it's getting really hard to afford a home. So I sometimes get accused of having charts. I like complicated charts more than I like my audience. So let me see if I can walk you through this. So what this chart is showing you is the distribution of the 100 largest market areas in the country and the price to income ratio in that market, the home price, median home price to the median income. Look at the left-hand side. So back in 1980, the line is the national level of that price to income ratio. It was about 3. 2/3 of the markets in the country, or half the markets in the country, were under 3. Another of like 40% were between 3 and 4. But for the most part, home prices to income were in this range of 3 to 4 times income. And that was generally taken to be affordable. If you go through the housing boom, the price bubble of 2004, you can see that price to income ratio got up closer to 5. And the number of markets in the country with price to income ratios under 3 fell to about 1/4. And now we're starting to see markets with price to income ratios above 5, which we hadn't seen before. Over the course of the deflation of housing prices after the bubble popped, that price to income ratio drifted down to about 3.5, never got back down to 3. But look what happened over the last couple of years. It spiked to a record level last year of 5.1. It's eased up a little bit this year as house price growth slowed and incomes picked up. But we're still at a point now where rather than having half the markets in the country under 3, we have 1. Syracuse, New York is the only market in the country where house prices are now 3 or less of times of income. And so we're at a point now where house prices in virtually every market in the country are at least 4, often 5, in many cases more times income. What does that mean? It means you're strained not only to try to find a mortgage you can afford, but importantly, the down payment that you're going to need to make that home a reality is becoming increasingly difficult. So as we look forward, if we're going to meet the need for that affordable home ownership, we're going to have to find affordable housing options that address the fact that prices have gone so many times income. So how are we doing on that front? So this chart is showing you trends in single family or other forms of owner-occupied housing, new housing over time. The top line is the number of new homes over 1,800 square feet. And then the yellow line is new single family homes, 1,800 square feet or less. The green line is manufactured homes, and the dark line at the bottom is condos. So if you go back to 2000, you add up the yellow, the green, and that brown line, you'll get to about 800,000 new housing units that were entry-level home ownership. So between small single-family manufactured and condos, about half the new market was small homes. Look at where we are now. Over the last 10 years, almost all the recovery in housing production has been among homes over 1,800 square feet. And those small homes are now only about 1/3 of the market. So at a time when entry-level home ownership is going through the roof, the demand for it, we're not building entry-level housing. If we look specifically at manufactured housing, I may be preaching to the choir in this room, but this chart shows you that manufactured housing was about 200 units back in 2000. That was actually after manufactured housing had peaked. If you go back here, this chart's taking you back to 1976 when the HUD code was first introduced. For years, between 1976 and the late 1990s, we were producing more than 250,000 manufactured homes a year. The line is showing you what share of overall single-family home production, adding conventional starts to manufactured homes represented. It was about up to 30% of the market was manufactured housing. If you're not aware of it, and Jim Gray can tell you the whole story, in the late 1990s, we had the first subprime crisis, which was in the manufactured home industry. There was a bubble that popped, and that industry really collapsed before the overall housing market did. And we saw those the manufactured home shipments go from 350,000 down to 50,000 by 2010. And the industry has only slowly recovered since then. So we're now shipping about 100,000 or so manufactured homes a year at a time in the past when we were doing more than 300,000. So there's a lot more potential in this industry than we've been realizing lately. So the question is, how do we realize that potential? Just a couple other factoids. One is that if we think about manufactured housing, this has been touched upon a lot today, it comes in different forms of tenure. And so on the right-hand side here, that dark orange slice is the manufactured home residents who own the home and own the land. So that's about half of the market. About a quarter of the market is they own the unit but rent the land. So a lot of the land lease communities we're talking about today. And another quarter where they rent both the house and the land. So we're thinking about for entry-level homeownership, I'm mostly talking about that right-hand side of this chart, which right now is about half of the market. And just to give you a sense of the distribution, this goes back to that point about me liking complicated charts more than I like you all, but there's a lot of information packed in here that I think tells a pretty good story. So what we do here is we take the 3,000 counties in the United States, estimate the share of manufactured housing in that county, and then we rank them from top to bottom. So the ones on the left-hand side are the 20% of counties that have the lowest share of manufactured housing. The ones in the middle are the middle of the distribution, and the right-hand side are the counties that have the highest share of manufactured housing. So from the top line, you can see it goes from 2.4% in places where manufactured housing is most rare to 28% in the 20% of counties that have the biggest share. So what are the characteristics of those places? So the second line shows your home value. So the places with high shares of manufactured housing have much lower home values. They have much lower populations. They have much lower population densities. Their home ownership rate is slightly higher. Importantly, it's much higher for BIPOC households in those places. And lastly, they have low household incomes. So the stereotype, as it were, of a manufactured housing rich community is rural, it's lower income, and it's low housing costs. And so that's really where the industry has largely been most concentrated. But it's a little bit of a misnomer, as it were. This chart is now showing you by region, where by the number of manufactured homes in large metro areas, small and medium metros, and non-metro areas. So the first thing that jumps out of this chart is that the South is home to a lot of manufactured housing. About 55% of all the units are in the South. But if you look at the South, there are more manufactured housing units in small and medium metros than there are actually in rural areas. So you've got 28% of housing in really small places. It doesn't add up to a lot of housing units. So even if you're only 10% of housing in a bigger place, it starts to add up. And in the South, you still have 1 million units that are in large metro areas. If you look at the West, they're kind of distributed evenly between large, small, and medium metros and rural areas. Midwest, it skews rural. In the East, Northeast, it's also kind of similar. So as much as we think of manufactured housing as being rural, it's actually in a lot of suburban and exurban and even urban communities as well. One of the things we were thinking about in our analysis of where manufactured housing is where might there be more opportunities to place these homes? So what we did here is we took all the counties in the country and we put them into a 2x2 matrix. We said, do you have an above average share of manufactured housing or below average? And then do you have an above average home price or below average? So the green areas are places that have high shares of manufactured housing. And then the dark green have high share manufactured housing and low home prices. And the light green have high share manufactured housing and high home prices. And so all those dark green areas are the kind of places that we think of as being ideal for manufactured housing. Low house prices, and that's where they're most common. The dark red places are areas that have a low share of manufactured housing and high home prices, places that would be hardest to place these housing. So that's the Northeast corridor, a lot of California, places like that. The light red are low housing cost places with low shares. So those are places where it seems like manufactured housing should have made more inroads, but haven't. And you can see those big swaths through the South and then to the upper Midwest where that's true. But one of the things we also wanted to look at, and it's hard to see on this map, is what about urban areas? And so we looked at large urban areas that have low house prices but low share of manufactured housing. So here's a list of those places, and the map shows you kind of where they're distributed. Again, in the South and in the Midwest primarily, places like Birmingham, Alabama, Jacksonville, Florida, Indianapolis, Louisville, Baltimore, Grand Rapids, all places that have very low housing costs but don't have very high shares of manufactured housing. They also tend to be low density urban areas. So think about, a Detroit or a place like that, a lot of single family homes. So there's a lot of opportunity in places that we haven't been looking, I think, to expand this type of housing. All right, so that's the kind of setup. How are we doing on time? All right, I gotta make sure I hit my marks here. So just give you a quick run through of our studies. Again, I'd recommend that if you're interested in this, go to our website. Hopefully this is a little bit preaching to the choir, but I think what we're trying to do is also make this information available to the folks that you're trying to reach to try to help make the case for manufactured housing. So in terms of the cost, what we did was we were actually able to piggyback on work that Next Step Network had done in conjunction with manufacturedhomes.com. And they did a survey of 22 manufacturers, dealers, and lenders in 2020. So this is all pre-COVID. And they asked them for very detailed estimates of the cost of a structure, the cost of transporting that structure, the cost of siting that structure. So they gave us all the kind of different components and put together those 22 different responses to come up with an estimate of what is it going to cost to produce different types of manufactured housing. We compared that to cost estimates for site-built homes using RS means, where we built a simple single-family site, conventionally built home, and compare those two. We also did it for the West Coast. I'm going to show you just the national estimates today, but the results are quite similar. And I should note that we did our best to try to control for the overall gross attributes of the house, but there still may be differences in quality that we can't control for by this method. But the results, well, I should also first say the three types of homes that we looked at were single section homes and double section homes. And here we have some of the key attributes of this traditional manufactured housing. Notice that it has a flat pitch roof. There's vinyl skirting, vinyl siding. And they typically sit up very high because they sit on pillars and they sit up higher than traditional housing. We also included the cross mod, which many in this room may be familiar with, a new form of manufactured housing developed by the industry as a way to counter many of the concerns about the aesthetic qualities of manufactured housing. So these homes feature a steeper roof pitch. They are sit on a permanent foundation. They're lower to the ground. They have a stone foundation. They have wood siding. They also include front porches, garages, and dormers, at least several of those features. They have more durable cabinets, higher energy efficiency standards, and higher quality bathroom materials. So for all the world, I would say the Crossbond looks like a ranch house. So we wanted to look at each of these different types of homes, including what might be a higher quality, say, manufactured home, and should make sure we're including that in the estimates. So here are the results. The bars are showing you the estimates for the price, again, as of 2020, and the diamonds are showing you what percent of the site-built home is the manufactured home. So on the left-hand side, the cross mod, we see that home comes in at 73% of the cost of a typical of equivalent site-built home. A double section home is 60% of the cost of a site-built home, and the single section home is 35%. So these are really enormous cost advantages that we were finding. And this is consistent with work that was done by HUD in the late 1990s that we were trying to replicate over time. And I think this is kind of what most folks instinctively know or believe, but we were trying to provide kind of more consistent evidence of that cost advantage. So one question is, all right, why? Why is it so much more efficient? And I think we don't have any ability to kind of pinpoint this, but the different ways in which it may come about is certainly efficiencies in production process from a factory setting. So no weather to be concerned about. Materials are available when you need them, and the like. Vertically integrating the production process, eliminating the use of subcontractors, savings on materials from large-scale purchases, the ability to incorporate advanced fabrication machinery at points in the production process, locating the factories in low-cost labor markets, and then there may be differences in the HUD code that allow for lower cost and more efficient building strategies. So putting all those things together is what we believe produces that advantage. One thing we didn't include in our cost estimates is just the cost of construction is land costs. And so then you have to then factor in what is the cost of the land that it sits on. And here what I'm showing you is if we went through, we looked at the American Enterprise Institute has estimate of house prices breaking out the cost of the lot and looked at the distribution of lot prices in 2020 across the country. The median value of a lot was $65,000. That's the gray bar. So if you start adding that large fixed cost to that construction cost, the cost advantage of manufactured housing declines. So on the right-hand side now, if we're saying we're going to be the more expensive markets in the country, how much is that cost advantage left? You can see cross-mod is now 86%, double section 80%, single section 70%. So this is, again, points to the fact that lower cost housing markets will be one where that cost advantage is going to be most evident, and places where we expect to see manufactured having the biggest advantage. So just in terms of our work on the barriers to manufactured housing, again, probably not unfamiliar to folks in this room. Number one is just the lingering negative perception of mobile homes, of these as mobile homes that are not in keeping with improvements in quality over time. Jim Gray referenced that this morning about the fact that we all drive around and we see this housing that is manufactured housing that's older, and that creates an image in our mind of what these homes are. And I think one of the studies we looked at found that when they had housing that was of decent quality, people didn't recognize it as manufactured housing, and so it wasn't able to counter that image. Zoning and land use restrictions that ban or make it extremely difficult to site these homes in many neighborhoods, another significant contributing factor. Market conditions that influence the demand for these homes, again, land costs being a key factor there. There's a unique supply chain for manufactured housing that relies on dealers as opposed to developers. So if I were interested in getting a manufactured home in my community and say, wow, I would love to take advantage of that cost advantage, what do I have to do? I've got to find a home dealer, got to go to the lot, got to pick out the house. I got to find the land lot that I want to put the lot on. I got to find a way to get it there. And so I'm now acting as a developer. Works in rural areas where I got granddad's 40 acres, I can put the house on in the backyard, and where I probably can't find a contractor to build me a house. But if I'm in an urban area, I need a different way of getting that house. And the manufactured housing industry has not yet developed a pipeline of developers who are buying these homes and siting them and selling them directly to consumers. And that's what our case studies will find. Some of that's starting to happen. And then lastly, the challenges that we've talked about a lot this morning in obtaining lower cost mortgage financing. If you get a 22-year 9% mortgage as opposed to a 30-year 4% mortgage, that cost advantage gets wiped out fast. So if you don't get access to long-term lower cost mortgage financing, the cost advantage of manufactured housing also starts to go away. So what will it take to overcome these barriers? Multi-pronged efforts are needed because the barriers are multiple. Education to overcome those misperceptions and get people throughout the process to understand. You have to address those local regulatory barriers. One thing I would point out is we found a number of states have said you cannot discriminate against manufactured housing. You have to allow it in areas where single-family housing can be built. Oh, but you still have to have a roof pitched like this, a wood siding like this, a permanent foundation and the like. So suddenly, yes, you can allow manufactured housing, but that manufactured house better look like a site-built house. So there's still barriers. New supply chains, as I mentioned, and then financing reforms. So just briefly, in terms of our case studies, we went around, we talked to a whole bunch of folks, trying to find examples of people trying to deliver manufactured housing in a new way. We came up with 5 examples we focus on. 2 of them are for-profit developers, 2 of them are not-for-profit organizations, 1 was a city. They're operating in Maryland, Virginia, Texas, Mississippi, Wisconsin, and California. The for-profit developers are both operating on a subdivision model, so they're looking to build new communities. The nonprofits and the city were doing more of an urban infill, trying to provide housing scattered site in their cities. You can see here, relative to our presumption that it's going to be low-cost markets where these predominate, the places in Maryland, Virginia, and California are actually high cost. So I think there's still a way in which that cost advantage will come through, even in some high-cost markets. The report will go through examples of what each of these did, just to kind of give you a picture of these. On the left-hand side is MH Advisors in Virginia. They're manufactured housing. You can see here that not using garages, they're trying to economize on the lot. So they're just using porches, but still it's a double section home with a steep roof pitch. And Spark Homes in Marion, Texas, does have a double garage that they were including. So the developers were sensitive to market conditions and what they were providing. So our big conclusions from the case study are: 1, zoning barriers and local approval processes are significant hurdles to overcome. They really were a battle that these folks had to go through to convince places. And their big arguments were about affordability and improved quality. And so I think affordability. When you're going into a community and saying, we're going to put in entry-level housing at $300,000, that gets people's attention. The educating of local officials and other key players is not just about getting approval, but it's also about the inspections. It's about the financing. It's about the appraisals. And so being a first mover, there was a lot of effort on the part of all these folks to educate not just the city, but all the other people in the chain. Site selection is key. It affects both the cost and the appeal of these things. Infrastructure in urban infill can be a real challenge. One of the things we were interested in was whether dealer licenses were an issue. That in order to become a developer, they had to also get licensed as a dealer. And in the states that we looked at, it wasn't onerous. But we did look at some other states that one of the developers said he looked in, I think it was Oregon, and the process of getting licensed as a dealer was too onerous for them to want to go there. So I think state licensing process will impact whether or not this is an avenue that's easy for others to enter. Appraisal and home buyer financing were important considerations in planning these developments. These folks wanted to hit affordability targets, so they wanted to make sure they were titled as real estate and eligible for mortgage financing. And as a result, all the case studies used the cross mod because of the fact that that's the way they were designed and their ability to access conventional financing really made a big difference. Look at that. I did speak at the speed of light there for the last 8 minutes, so I appreciate you all hanging in there. If you could play back the tape, you can slow it down. That's what my students do. I'll just conclude by saying that really it's a great opportunity to do this study. I'm a big fan of manufactured housing in a time when we can't find another way to build simple entry-level housing. It has real opportunity as these exurban subdivisions, also as urban infill. And I think we kind of know what we need to do. We need to educate. We need to get the financing products. But I think some of these examples are starting to get attention. NPR was covering MH Advisors when they had their opening. And I think the more we can proselytize this, the opportunities here and more build up that supply chain, I think the more it'll take off. But I don't think we have time for questions, but I'll be sticking around if anybody wants to ask me anything. But do check out the reports. I hope they're of value. Thanks.
It is my honor, actually, to introduce the third panel here, Perspectives from Manufactured Homeowners. We felt it was really important to include in the agenda today the opportunity to hear from people who are most impacted by a lot of the policies that we've been discussing today. We're incredibly grateful that these panelists are sharing their time with us today to provide their reflections on the challenges and opportunities facing manufactured homeowners. And it looks like we're all set up. And with that, I'm going to hand things off to our moderator, Jeannie Wright. She's a cooperative project coordinator with Rock USA, who you've heard mentioned a couple of times today already.
All right, I think this is on. Good afternoon, everyone. I'm super grateful that they saved the most engaging panel for after lunch. I really thought, whew, excellent. I hope everybody enjoyed that. And I'm super excited to be here. I want to start, I don't think I heard it in the room today, but I know that there are more than 22 million Americans that live in manufactured housing across the country, and they live in one of 43,000 communities. I'm fortunate today to be sitting at a table that is completely comprised of manufactured housing residents, self-included. Our discussion this afternoon is really going to be engaged around emerging challenges and opportunities that residents are seeing in their manufactured housing communities. And let's face it, these are the experts in the room, right? The folks that live in these communities. We've heard from a lot of people today, but I'm really hopeful to hear from each and every one of them. This is going to be a conversational piece. We're going to be engaging each of our participants in questions, and we will have an opportunity near the end of our conversation, hopefully if time permits, to open for questions. And just a reminder for everybody to use Slido. And the trainer in me will tell you that you'll go to the app and you'll download it. And if you ask a question, if you like somebody's question and you hit like, it'll move to the top of the list and I will probably get to your question faster. So I think we're going to start by just going down the line, and I'm going to ask each of our participants to introduce themselves. Tell us a little bit who you are, what community that you're from, and what specific role you hold in the manufactured housing world. We'll start with you, Maureen.
Okay, hi, good afternoon. Thank you all. My name is Maureen Schindel. I am with Evergreen Village Cooperative up in Mount Bethel, Pennsylvania. I was the interim president during the purchase process and currently working with the board in other capacities. I'm also a realtor with Keller Williams up there, so I have my fingers in a lot of the pies up there.
My name is Charlie. My name is Charlie Marsteller. I'm a resident also of Evergreen Village, neighbor of Maureen, and I'm a retired school teacher. Retired a few years ago, and we moved into a manufacturing home community. And I came out of retirement because of that, to get involved with some of the issues that we are facing.
Hello, I'm Bob Biesecker. I'm from Douglas Village in Douglasville, Pennsylvania. It's about 40 miles to the west of here. And I've been in Douglas Village for the last 6 years. And about 2.5 years ago, we learned that significant rent increases were on the way. So we became involved. Since then, we found it necessary to form a coalition. So I'm the volunteer leader of the Coalition of Manufactured Home Communities of Pennsylvania. And we represent thousands of residents in manufactured housing through that coalition.
Hello, I'm Joseph Sullivan. I'm the Executive Director of the Manufactured Homeowners Association of New Jersey. I'm also the Vice President of the National Manufactured Homeowners Association, and I am a member of the Manufactured Housing Consensus Committee for the Department of Housing and Urban Development in Washington, D.C. I have lived in manufactured housing for over a decade. I've seen the issues that many residents face, and that motivated me to get involved.
Excellent. Thank you, everyone. So we're going to start the conversation today with Bob. Bob, I think many of us have heard here today a lot about rent control and issues with increasing rents across the country. Specific to your neighbors at Douglas Village, Bob, and how have these unreasonable rent increases impacted your neighbors?
Okay. Well, first of all, I'd like to thank the Federal Reserve Bank and the Pew Charitable Trust for taking our economic problems seriously and wanting to know how a lack of monetary policy affects our pocketbooks and our lives. So thank you. Because of the historic affordability of manufactured home communities, retirees plan their senior years around a budget that doesn't require all of their income to go toward housing. We can have a comfortable home with a pleasant setting and friendly neighbors, and we enter into it predicting that it's not going to break the bank. But that's not working out the way we had planned it. The typical 55-plus manufactured home community has many single residents who make up 43.7% of the homes. And of that, 35.5% are females. Most of those are widows. Vietnam-era veterans or their widows are 36.7% of the households, and male veterans comprise 41.6% of the male village population. So those are the numbers, but who are the people that are living in those neighborhoods? Okay, there's Nancy from Bath, Pennsylvania. She's been a resident of her community for 8 years. She and her husband are on disability. After their community's ongoing rent spikes, they have cut back on their medication. There's Rod and Joe from my village in Douglasville. Both are veterans. Both are wheelchair bound. They and their wives had everything planned out until the vicious lot rent increases started to come. Both of their homes are adapted to accommodate their special needs. Joe's wife said to me, we were very fortunate in that the VA came in and put most of the apparatus that Joe needs in place in the home. But it's a one-shot deal. If the rent keeps going up and we have to move, we lose that and they won't put it in another home. So they feel trapped. And finally, there's Peggy from Allentown. Her daughter is deceased and she is the sole provider to her minor granddaughter. One more large rent increase will outstrip her income. The last time I spoke with her, she said, quote, I'm looking at homelessness. So I could spend my whole time telling you stories about people like Nancy and Peggy and Rod and Joe. They're in manufactured home communities throughout our state and probably throughout the country. I hear their stories or I read their stories through emails practically every day. So that's who the people are.
Great, thank you so much. And a question about rent control, Bob, for you is, what do you feel reasonable rent control regulation looks like?
Well, I think you have to maybe first understand a little bit about what has been happening with the rents. The community where I live in Douglasville has been assessed 13% to 15% multi-year monthly lot increases. That's after a decade of moderate increases. The community in Annville, Pennsylvania, residents there reported a percentage increase of 9.7% lot rent increase in 22, 10.1 in 2023, and 13.7% this year. Reflecting back on a prior panel's comments, there was discussion about sewage issues. I can tell you that you can drive right now 90 miles to the west of where we're sitting, and you'll find raw sewage running through that village in Annville. It's the real deal. In Bath, Pennsylvania, an 8.4% lot increase occurred in 2023, with another increase expected this month. Now you have to understand, they're currently paying $904 per month already. In Allentown, Pennsylvania, they just received a monthly increase of 51.2%. In this enormous economy, the typical mom and pop or family-owned manufactured home community is mostly gone. Those owners who knew each resident by name, who worked directly with residents, and who often lived on site have largely been replaced by out-of-state private equity firms that we've heard about all day, who care about one thing, and that's turning us into their private ATM machine. It's maximum profit as quickly as possible, jack up the monthly lot rents, decrease maintenance, and in a few short years, sell the holding and find a new investment to flip. Our coalition is currently following two bills in committee in the Pennsylvania General Assembly that would relieve the indiscriminate rent pressures in our community. House Bill 805 has been in the Housing and Community Development Committee since April 2023. We were told this past October that they were, quote, working on it, unquote. And most recently, in a committee meeting that I had a chance to view, they said that they were really, really going to be working hard on manufactured housing issues during the summer months. We'll see. We're also watching what happens with Senate Bill 861 in the Pennsylvania Senate's Urban Affairs and Housing Committee. That bill has been there since last July. If either of these bills become law, they would curb yearly lot rent increases to a level not to exceed the consumer price index. It's also very obvious that there are firms with deep pockets who don't want to see these bills see the light of day because it doesn't fit their business model.
Great, thank you so much, Bob.
Yeah.
I'm going to move on to Joe next. Joe, you and I recently had a conversation about the misconception of the affordability of living in a manufactured housing community. Can you talk to us a little bit about the what you meant by that misconception of affordable lot rent and the costs associated with actually living in a manufactured housing community?
Well, when I was discussing issues facing manufactured homeowners in New Jersey with elected officials, and when it also went before the courts, there was this misconception that when you are renting your lot in a manufactured home community, that it's like an apartment or renting a house where you don't have to maintain it, you don't need to pay property taxes. And that was all untrue, because if you rent a lot in a manufactured home park, you have to own your home, you have to maintain your home, you have to pay the property taxes on the home, which is usually what they call a pass-through, which is they take whatever the property taxes are for the complete park or community and divide it by the number of homes, and then you have to pay that part of the property taxes. So not only are you renting the land you live under, but you're paying the property taxes on it, and you're paying a lot rent fee for it. And you still have to maintain your home. You still have to pay insurance. And if you don't maintain your home, as we heard earlier, a park or community can decide to evict you. And that's kind of what we are seeing as corporate investors come in. They decide to get very stringent on the rules when it comes to how you maintain your home, because it's a way of getting out people that pay lower lot rents to bring in people that will pay higher lot rents in a new home.
Great, thank you. And how does that impact the residents' ability to even stay in their home?
Well, in communities that I've seen in New Jersey that have been bought by these investment groups, many people are coming to me and telling me we have to choose whether or not we're going to pay the lot rent or pay for our medications or pay for our food. We have to figure out ways of spending less money on food because we can't afford to eat and pay the rent anymore. And they know that they don't have the money to move their home. So in the event that they are evicted for not paying their lot rent, more than likely they will end up having to abandon the home to the park owner. And so they lose everything.
Oh, that's powerful. Thank you so much, Joe. So next, before I introduce our next panelist, I just want to briefly give an overview of some work that we did. In 2022, I had the pleasure of working beside the homeowners at Evergreen Village. There are 158 sites in Upper Mount Bethel. They had an interesting story because they had a mom and pop owner, and their mom and pop owner decided that when he was ready to retire and sell, he didn't even put his park on the speculative market. He came to Rock USA and he said, hey, how do I do this? He actually he emailed his residents at the same time and said, I want to sell the park through Rock USA, good luck. It was actually, it's a funny story. Truth be told, he had other offers on the table. He had folks coming to him and saying, but he really felt like he could invest his legacy into the residents. And they ventured out as pioneers in the state of Pennsylvania. They were the first group of residents in Pennsylvania to work alongside us, and they were successful. And I'm going to next lean on Maureen, who was the interim board president at the time, and ask her some questions about that. Maureen, tell us about the barriers to resident ownership. So it sounds great, right? They're going to sell to the residents, take the rent security out of it. You're going to operate, make all the decisions on your own. But what were some of the barriers that happened through the acquisition when you were exploring the viability of the purchase?
Well, after the initial barriers of fear and shock from the residents, because as Jeannie said, it was a family-owned community since its inception. So a lot of the people, my neighbor's been there for 36 years, so a lot of the people have been there forever. So they just, some felt like the rug was being pulled out from under them. So it was a huge barrier in trying to build some security, some goodwill, and communicate what we were trying to do. From a financial perspective, we bought the park for $12 million. So clearly that was a huge barrier, and financing became an issue because rates were going up. We were with one bank and then we went with another, and it was really a challenge making sure we were getting the best deal for everyone and keeping the rent increases as low as possible. Our due diligence of the community showed that there was much work to be done. Our rent was quite reasonable before the purchase. However, we realized as we went through it that we had a lot of infrastructure work to do. Our sewer plants, our water, all of that wasn't maintained as well as it should be, for lack of a better term. So we had that to deal with. Also, as Jeannie mentioned, we were the first in Pennsylvania. So not always good to be the first, but we learned a lot, and we worked with, Jeannie's team was amazing. We worked with a group of lawyers who were phenomenal and really wanted to break through any barriers that were there so that we were the first and we could set the groundwork for others to do it. And I believe that is moving forward in other communities in Pennsylvania. So it was really a matter of convincing the residents that, yes, your rent is going to increase, it's necessary. And as Joe mentioned, some of the horror stories we were hearing were also kind of like the icing on the cake that said, we really have to do this. People being told to move their houses out because they didn't meet the requirements of the new owners, and rent increases up to over $1,000 really made our point that this was the best thing for us to do at the time, and is now.
And a follow-up question to that, Maureen. So I know firsthand that the rent was a pretty significant one to take on the cost to operate the park plus the debt to purchase the community. What do you think were the driving themes of why residents voted to take the ownership, even though they knew that their rent was going to increase?
One of the driving themes was it's actually a wonderful community. It's quite beautiful, and there is a very strong sense of community. So I think knowing that everyone was in it together helped people realize, okay, I'm not alone, and we're going to get through this. The fear of displacement, was talked about here and other panels. We eliminated that because we took control, and that was the big thing. We took control. We took control of the infrastructure. We took control of the processes. We had a board that took care of everything. We had the operation of the community under our control. We knew what needed to be done, and we now understood how to keep us as a community and how to make sure it all worked together. So there was great security in that. There was a great sense, even stronger sense of community that allowed us to work together and say, all right, we're in this together and we're going to get it done.
Awesome. So next up, so Charlie. So Charlie's the current board president, as he mentioned. And obstacles, I think we're going to talk about whether or not you think they still exist. Not only, like she said, they bought a 158 site community, but I know that they bought a community system at a giant waste treatment plant on site that serviced all 158 homes. So now that you're owners, Charlie, how are you guys tackling that challenge of addressing infrastructure issues?
Well, to piggyback on what was just said, we were one of the new residents who, 2 months after we moved in, the owner decided to tell us that he was selling. But part of the appeal that of Evergreen Village is we have approximately 1.5 miles of tree-lined streets, and we are surrounded by farmland and some wooded area, which aesthetically great. And I think that's what holds a lot of people there. They've built their life around living in Evergreen Village. They also present the other challenges. For example, as we mentioned, we have our own wastewater treatment plant, our water supply, leak sewer system or system that we could tap into. It's a maintenance and broken down at the wastewater that do come up. And something that stands out to me when we were interviewing with the former owner, something came up in the discussion, and I still remember to this day his quote that I don't go looking for trouble. Sounded good at the time. In other words, I was thinking of the rules and regulations that were in place. I've come to the conclusion now that some of that involved the infrastructure, because what you see on the surface might look okay, but and you're not looking for the trouble, but under the ground or in that room down there that houses the pump system, there is trouble brewing if it's not maintained and updated. And we have been finding out when we fix one thing, inevitably something else along the system goes wrong. So we're doing our best to budget for that. And what really comes in handy is with Rock USA's guidance there, we've been able to tap into some grant money, the FAIR grant for one, which has given us a little more confidence to take those initial steps to address these issues that come up and plan long term for that. There's also, as I said, the surrounding forest. A large portion is old wood, dead trees that are, you look at them and hope the wind doesn't blow too much. But we have to prepare for that as well. And our beautiful tree-lined streets, they're locust trees, I believe, and they probably looked nice when they were little saplings, but now they do present other problems with the root system on the sidewalks and the lighting that attracts many of the people who have moved there. The electrical wiring was there also. So these are problems that we're looking into, we're anticipating, and we're not looking for the trouble, but we know it's brewing, and we're trying to anticipate and plan accordingly so that, as was noted, the long-term residents can enjoy their life and maintain what they've always been used to. So.
Awesome. And a follow-up question about that, Charlie. Tell me, how do you see the residents are addressing these issues differently than your prior owner would?
Well, I think we're developing a network of neighborly assistance, helping each other, and volunteers. We do have some a volunteer committee for those of us who are still able and anxious to keep active. The demographics of the community, it is a 55 plus community. So we do have some still in the workforce. We have some who, as they've been 30-year, 40-year residents, aren't capable of doing the physical work, but they do offer other things. We have clubs, the social outlets and things like that, and ideas that are offered. So we try to welcome everybody's ideas and experiences. We currently have a gentleman who just moved in last year who, when we found out he had for many years had his own construction business, there's a good resource. And he still has access to one of his backhoes, which has come in handy. So it helps us to address some issues as they come up and keep the costs down. And we also have few of us who get together. It's a time of, let's say, fellowship while we're working and sharing the workload and for getting to know the residents as well. Even in the winter, we're responsible for the the clearing of our sidewalks with snow. Well, there's always one or two on each street that we get the snow blower out and we do the whole block, that type of thing. So I think learning and education is a big part of it, because there was a lot of fear and apprehension going into this about some of the horror stories and the statistics that we've heard about. So that's part of it too, is neighborly comforting or assuring others that they're being looked after and that we're doing our best to keep the village going.
Great, thank you, Charlie. All right, so we do have some questions. I think it's time for questions. And again, the Slido is still open if folks want to drop some more in. I think this first question that I see is, what do lot rents typically cost per month to rent? I think I'm going to lean this question, or if anyone calls up, maybe Joe or Bob, maybe one of you want to tackle what you're seeing for average rents, lot rents in the area.
It is interesting. It can be anywhere from the high 300s to $1,000, depending on the community. And the interesting thing is, some of the better communities that I would suggest people should live in have the lowest lot rents. And some of the worst communities that have the worst services and the worst infrastructure have the highest lot rents.
I agree totally with what Joe just said. That's the way it is.
And if I may, Jeannie, as a realtor, I work with a lot of people that are looking for affordability housing. And that's one of the things that's got to be taken into consideration. For example, a couple I'm working with now, they need to get a loan. So they need to make sure that their loan payment and their lot rent payment is covered by their income. So the lot rent, sometimes more than the location or the actual quality of the house, can dictate where somebody lives. So it really depends. We're looking at places that it's like $350, and then some of them go up to $980. So the disparity is amazing. And we're fortunate in Evergreen Village. We have a number of amenities that are included in our lot rent. But I've seen rents up to $800, $900 where there's no pool, there's no clubhouse, there's none of that we are actually enjoying in our community. So you really have to do a lot of due diligence, at least I do as a realtor when I'm working with people who want to live in these communities, to make sure that, it's where they want to be, but that they can afford the lot rent and any loan payments they have to make, as well as the cost of living, medical, all that. So it's certainly a deciding factor in helping people decide where they want to go.
Awesome. And a follow-up to that, Maureen, I think specific, a question, how much did you raise the rents when the residents bought the community?
We raised the rent $290. So obviously a sticker shock for a lot of people. Tried to ease it in and help them maintain and build up to it. But it's a lot of money. There's no getting around it. It's a lot of money, especially for someone on a fixed income.
So on the lot rents today, Maureen, where do they sit in average to nearby communities across the county?
We are probably in the middle. I noticed the median on one of the slides was $634. We're at $750 now. So we're a little bit higher than the national average. But as far as our location, we're probably in the middle. The lowest, like I said, I've seen is like 500 and then up to 900. So we're kind of smack in the middle there.
Excellent. Thank you. There are more questions. I think I'm trying to stick to the ones specific to our panelists today. I think some of them are really being directed at me, and I really want to focus on the folks that are here. But there's a question about, what about people who could not afford those rent increases? Was there any help for those folks?
From our perspective, like I said, we worked with people to ease it in. there were opportunities within the county and worked with some of the local representatives to see if people can get some sort of subsidy. So it's something that you have to go, it's a case-by-case basis, obviously. But we did work with folks to see if they could. Fortunately, we really didn't lose anybody initially for the rent increase. Again, as a realtor, I keep track of that, and we really had very few sales because of the rent increase. We had some salespeople moving down south or whatever, but none that I can specifically say were determined by the rent increase.
If I could add to that, we do have rent payment methods for a rent payment plan or something if someone runs into a hardship or whatever. And also, we're very close to the New Jersey-Pennsylvania border, and even with that rent increase, we get occasionally people from either of those states or higher cost of living areas who don't blink at what we're paying. So, yeah.
I can speak to our village only in this regard, and that is we haven't had anyone evicted because of non-payment of rent, but we have had a fair number of village residents follow the advice that management gave us when they first acquired us, and that is, if you don't like the rent increases, you can leave. And some have.
Well, I know we need to wrap at 1:55 to leave time for closing remarks, but I also wanted to take a minute and ask all of the panelists today. A lot of important people here today. A lot of important people, I think, participating remotely. If there was one last key point that you could make to participants that may have some impact in less than 30 seconds, what opportunity exists for those living in manufactured housing? How could people support you in that arena?
All right, I'll go first. Honestly, I think, number one, removing the stigma, and I saw that in many of the presentations. When I say manufactured housing, oh, you live in a mobile park, you live, a trailer or whatever. Removing the stigma, because I love my house, it's gorgeous, I'll be honest with you. And so I think we need to change that. But again, from my evergreen hat and my realtor hat, financing. It's so challenging for people to get financing. I just had a client, we got financing. He paid 11-something%. They charged him over $3,000 broker fee just to originate the loan. It was ridiculous. The client I'm working with now, there's this 10% interest rate. And it's just so hard to, and you can only get a 15-year loan, so it makes the payments even more. It's just so hard for people who really want to be able to live on their own, have a nice house, but are at that stage in their life where, the pie's only this big and people want to take more than they can afford. So please, whatever you can do to help us with financing and help the whole manufactured home community, with financing and making it easier for people would be wonderful.
Great. Thanks, Maureen. Charlie?
Yeah, I found that if we take that neighborhood approach to me, that in many places has been lost today in our country, that looking out for one another, whether it's helping out physically or even with our skill set of knowledge and experience, helping people find the resources that are available that would help them if it's beyond our own means. And like we said, we're looking for local community involvement, making connections there, and also the grant money that's out there. It's not that we're looking just for handouts. I think we have a good group of people who are willing to put some skin in the game, so to speak, and put the effort in. We just need a little extra help sometimes to get over that first hump and get things started, and then we will work better to maintain.
Great, thank you, Charlie. Bob?
This is not only a lot rent issue for the people living in manufactured housing, it's about consumer protection. To our representatives and senators from the Pennsylvania General Assembly, lawmakers have a choice. They can support the out-of-state private equity firms, or they can support the residents of the Commonwealth. It's really their choice to make. Our veterans and our disabled, our families are being priced out of their homes today. So to our elected officials, if not now, when?
Thank you, Bob. Joe?
I think I'm fortunate that in New Jersey, we see the state legislature starting to pay attention to manufactured housing, and I'm grateful for that. But as they have reached out to me, they also understand there's more that needs to be done. We have to walk away with the understanding that I believe the majority of residents in manufactured housing tend to be older, tend to be on fixed incomes. They can't afford what these equity firms are trying to pull out of them. And so any help we could get to fight that would be gratefully appreciated. If it helps to get more resident-owned communities, if it helps that we could perhaps get more funds for rehabilitation. I could give you an example. I'm not going to mention the name of the town. They have a rehabilitation program for homeowners. If you have a stick and mortar home, you get $30,000. If it's a manufactured home, you get 10. So these are the kind of things we have to fight, and hopefully people realize these aren't the trailers of old, and these homes need a lot of work, just like a stick and mortar home, and any help we can get in these areas will be greatly appreciated.
Excellent. Thank you so much, Joe. And again, I want to thank all the panelists for participating today. And I know a lot of them took time out of their day to drive over. There is a slide up that has some contact information. It's clear that several of you have some questions about resident ownership. I'd be happy to answer if you want to reach out. I will be around afterwards. I think the panelists will still stick around if folks have more questions. But again, I just want to appreciate being part of today. It's been a very educational and informational day.
Don't even move, because I'm going to give you all so much love in a second, because I so appreciated that. I'm Teresa Singleton. I'm a Senior Vice President and Community Affairs Officer here at the Federal Reserve Bank of Philadelphia. And today's been just tremendous for me. I want to start off by thanking our partners at the Pew Charitable Trust for their just collaboration and bringing together this amazing agenda today. I also want to thank all of the panelists who are still here. I think that they shared amazing programs, resources, and models that I hope all of you here in this room and online will be able to use as you go back and do your work. And I also want to thank my dear colleagues, Eileen DeVringy and Patricia Bell for organizing, as well as Grace and Jeremy for providing all of this back-end support. It's been really an amazing day. I saved you for last. I wanted you to stay here because I want to tell you how important this panel was to me. I am surrounded by people who talk nothing but numbers all day, and I love them. I love a complicated chart. It tests me, but there is something about the power of storytelling, and so I want to tell you how much I appreciate you coming up here and sharing your stories and the stories of the people that you live and work with. Our president is fond of saying, data is powerful, but it's backward looking, and it also blurs the face of the people that we are doing this work for. So I want to, again, give you all a round of applause and thank you for doing it. I am not going to take time because it is almost 2:00, and I just want to say it's clear from today's conversation that manufactured housing, the issues around financing and quality are still complicated, and it's impacting this really important part of our housing stock. But I walk away from today's conversation really hopeful that we're beginning to shift the narrative, and I know a lot of people talked about this image of mobile homes and manufactured park homes of old. When I first got into housing, housing many, many years ago, we talked about manufactured housing as a problem to be solved. And I think today we're really talking about it as a potential solution, a housing option that many people can take advantage of, that we need to solve for, that we need to support and preserve for folks who are here today and folks that see this as an option going forward. So I'm going to give one last thanks and then a request. How's that? You give a little, you get a little. I want to thank you all. I want to thank you for your energy, your interest, and your focus on manufactured housing. There are a lot of important and smart and impactful people in the room. I want you to take the opportunity to use your evaluation form to tell us what else we can be doing on this topic. Everywhere we go, we hear about affordability issues that are impacting people at every income level. And manufactured housing can be one part of the solution. We want to hear from you. What are the questions we need to be asking, data we need to be collecting, research we need to be doing, convenings we need to host to further leverage this energy that I think we're building today in changing the narrative and providing the support that's needed to continue our work, bringing more resources, more attention, and more programmatic activity. So I want to thank you again. Please fill out your evaluations. She reminded me twice, so I'm saying it to you twice. And this is the most timely event I've ever been in. She's been on all of us. So I want to thank you all, and I hope you stay around, chat, exchange contact information. And again, please let us know what else we can be doing in this space. So thank you.